The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Semi-Annual Testimony on the Federal Reserve Supervision and Regulation of the Financial System. I now recognize myself for 3 minutes to give an opening statement. As we all know, the Dodd-Frank Act vastly increased the powers of the Fed way beyond its traditional monetary policy responsibilities. The act has made the Fed omnipotent, but it cannot make it omniscient. No act can. Through the exercise of so-called heightened prudential standards, the Fed can now functionally control the largest financial institutions in our economy. Former Fed Governor Kevin Warsh recently wrote, quote, "Central bank power is permissible in a democracy only when its scope is limited, its track record strong, and its accountability assured." None of that do we observe today. Where has the Fed's omnipotence taken us? The big banks are now bigger, the small banks are fewer, economic growth lags, and there is scant evidence our economy is more stable. Two new Fed expanded authorities granted under Dodd-Frank, living wills and stress tests, have been particularly controversial and problematic. The secrecy surrounding the stress tests make it almost impossible to measure the effectiveness of the Fed's regulatory oversight or the integrity of the test findings. As Columbia University professor Charles Calomares has testified, quote, "It is hard to believe that the current structure of stress tests could occur in a country like the United States, which prizes the rule of law, the protection of property rights, and the adherence to due process." Dodd-Frank's living wills grant the FDIC and the Fed unbridled and unreviewable discretion to fundamentally restructure private businesses under a standardless process that relies entirely upon the personal discretion of Washington regulators. Indeed, the Fed stands at the center of Dodd-Frank's codification of too big to fail. It functionally occupies the boardrooms of the largest financial institutions in our nation and decides how they can deploy their capital, sending a clear signal that Washington will bail them out if they get in trouble. And despite claims by the Fed that it tailors regulations to fit the size of financial institutions, we know small banks are suffering disproportionately under Washington's thumb. As we lose on average one community financial institution per day, consumers lose options to help them achieve financial independence, small businesses lose opportunities to grow jobs, and the big banks just keep getting bigger. There is a better way. Former Fed Chair Alan Greenspan has said, quote, "Lawmakers and regulators, given elevated capital buffers, need to be far less concerned about the quality of the bank's loans and security portfolios, since any losses would be absorbed by shareholders, not taxpayers." This would enable the Dodd-Frank Act on financial regulation of 2010 to be shelved, ending its potential to distort the markets, a potential seen in the recent decline in market liquidity and flexibility. Tom Honig, current FDIC vice chair, has said, quote, "U.S. banks engaged in core banking activities and operating with reasonable levels of capital should not incur the same regulatory burden as those that do not." Former FDIC Chair Sheila Bair has also expressed support for the use of higher capital levels in place of regulatory risk weighting. She has said, quote, "The Fed doesn't know what's risky. The FDIC doesn't know what's risky. Didn't we learn anything from the crisis?" Unquote. The Financial Choice Act approved by this committee offers a better way. It has been endorsed by renowned economists nationwide, including 3 Nobel Prize winners, by promoting substantially higher loss-absorbing bank capital in exchange for relief from job-killing regulations. The Financial Choice Act fosters economic growth for all, bank bailouts for none, and ensures the Fed is accountable and remains focused on good monetary policy. Chair now recognizes the ranking member for 5 minutes.
Thank you, Mr. Chairman, for holding this hearing, and thank you, Chair Yellen, for making yourself available to testify today. Just a few weeks ago, we passed the 9th anniversary of the Lehman Brothers failure. Leading up to 2008, much of the risk in our banking system went entirely unchecked by regulators. Failure to quickly address fraud and mismanagement resulted in the loss of more than 8 million jobs. As unemployment topped 10%, millions of families lost their homes and entire industries were on the brink of collapse. Congress responded to this devastation by passing the most comprehensive overhaul of our financial system since the Great Depression, the Dodd-Frank Wall Street Reform and Consumer Protection Act. The Dodd-Frank Act greatly increase the Fed's responsibility and authority for safeguarding the financial system, but also set minimum standards to ensure that regulators didn't lose sight of emerging risk again. The Dodd-Frank Act has required regulators to increase capital and liquidity standards, reduce interconnection in the financial markets, and more closely scrutinize large financial firms' risk management. However, there's much work left to be done. As we have seen from the enormous failure of risk management at Wells Fargo, it's important to remind the committee and the public why these reforms were necessary in the first place. Fraudulent retail banking practices may not, in and of themselves, pose systemic risk, but they surely indicate mismanagement that could be catastrophic in riskier and more complex divisions of a bank holding company. Supervisors and law enforcement must continue to hold both institutions and individuals accountable. Chair Yellen, I know you will keep that in mind over the next several weeks as you review living wills from the 5 banks that failed their submissions in April, and that includes Wells Fargo. Chair Yellen, I'm eager to hear about the Fed's progress in implementing Wall Street reform and how the board's supervision practices have evolved over the last several years. Specifically, I'm interested to hear more about how the Fed is using the flexibility embedded in Dodd-Frank to tailor regulations appropriate to the sizes and risks of different types of banks. Dodd-Frank also provided the Fed, in consultation with the Financial Stability Oversight Council, with new responsibility to regulate the activities of systemically risky non-banks, entities such as the insurance company AIG, whose near failure imposed dire systemic consequences on our economy just 8 years ago. Since the passage of Dodd-Frank, Congress has given the Federal Reserve additional authority in setting capital standards for insurance firms subject to enhanced supervision. Look forward to hearing about the board's progress on regulating insurers. Yet, just a few weeks ago in this committee, the Republicans pushed a bill that would severely undermine efforts by the Fed to regulate the financial system. The chairman's misguided legislation would repeal the Financial Stability Oversight Council's ability to designate non-banks for enhanced supervision by the Fed, creating a huge swath of unmonitored risk in our financial system. The legislation would also replace carefully considered limits on banking activities with nothing but an insufficient 10% equity cushion, encouraging the reckless and risky behavior that nearly destroyed our economy in 2008. Moreover, as we in Congress consider another funding resolution, we must be mindful of continued attempts to defund regulators' work implementing Dodd-Frank. For the first time in recent memory, economic data indicates that the middle class is benefiting from the recovery. Failure to heed the lessons of the past will put that progress in jeopardy. Thank you, Mr. Chairman, and I yield back the balance of my time.
Chair now recognizes the gentleman from Texas, Mr. Nagebauer, Chairman of our Financial Institutions Subcommittee, for 2 minutes.
Thank you, Mr. Chairman. Today's hearing is fundamental to understanding developments in the prudential supervision and regulation of our nation's financial institutions. The role of Vice Chair of Supervision serves as the statutorily designated official within the Federal Reserve to oversee supervision and regulation. In 2010, former Fed Chairman Paul Volcker, champion of the Volcker Rule, noted that the creation of this spot might turn out to be one of the most important things in here, meaning the Dodd-Frank. It focuses the responsibility on one person. Yet President Obama has failed to nominate anyone to fill this important position, a position that sets prudential regulatory policy and represents the United States in international banking forums like the Financial Stability Board. I remain concerned that Governor Dan Torello continues to exercise these authorities outside the statutory construct and mandated oversight of Congress. Today, I hope to understand better many of the recent regulatory actions taken by the Federal Reserve. For example, how does the Federal Reserve's posture on reducing bank leverage interact with its recent recommendations to repeal the Merchant Banking Authority? On what type of risk that the Fed is trying to mitigate in a recent capital proposal for commodities activity? Similarly, what would the impact be on end users if physical commodity activity decreases or stops? And finally, does the Federal Reserve recognize the exposure-reducing characteristics of segregated margin, and does it plan to reevaluate its position in the leverage ratio rule given recent Basel Committee discussions? While Chair Yellen may not be the best position to answer these questions, it is incumbent upon her to do so given the presidential inaction. And with that, Mr. Chairman, I want to say this is my last time to be in this committee with the Chair Yellen. I'll thank Chair for her making herself available to us, and thanks again for her service in her capacity. And with that, I yield back.
Gentleman yields back. Today we welcome the testimony of the Honorable Janet Yellen. Chair Yellen has previously testified before our committee on a number of occasions, so I believe she needs no further introduction. Without objection, Chair Yellen, your written statement will be made part of the record, and you are now recognized for 5 minutes to give an oral presentation of your testimony. Thank you.
Thank you. Chairman Hensarling, Ranking Member Waters, and other members of the committee, I appreciate the opportunity to testify this morning on the Federal Reserve's regulation and supervision of financial institutions. One of the Federal Reserve's fundamental goals is to make sure that our regulatory and supervisory program is tailored to the risk that different financial institutions pose to the system as a whole. As we saw in 2007 and 2008, the failure of systemically important financial institutions can destabilize the financial system and undermine the real economy. The largest, most complicated firms must therefore be subject to prudential standards that are more stringent than the standards that apply to other firms. Small and medium-sized banking organizations, whose failure would generally pose much less risk to the system, should be subject to standards that are materially less stringent. The Federal Reserve has made substantial progress in building a regulatory and supervisory program that is consistent with these principles. We have implemented key standards designed to limit the financial stability risks posed by the largest, most complex banking firms. We continue to work on some remaining standards and to assess the adequacy of this package of measures. With respect to small and medium-sized banks, we must build on the steps we have already taken to ensure that they do not face undue regulatory burdens. Looking forward, we must continue to monitor for the emergence of new risks, since another key lesson from the crisis is that financial stability threats change over time. The Federal Reserve's post-crisis efforts to strengthen its regulation and supervision of large banks have focused on promoting the safety and soundness of these firms and on limiting the adverse effects that their distress or failure could have on the financial system and the broader economy. We've aimed to increase the resiliency of the largest banking organizations by establishing a broad set of enhanced prudential standards, including capital and liquidity requirements for large domestic and foreign banking organizations. And we've aimed to make large financial institutions more resolvable through, for example, the living will process and our proposed long-term debt requirements. The introduction of capital stress testing for large banking organizations has been one of our signature regulatory and supervisory innovations since the financial crisis. As events during the financial crisis demonstrated, capital buffers that seem adequate in a benign environment may turn out to be far less than adequate during periods of stress. For this reason, the Federal Reserve conducts supervisory stress tests each year on banking organizations with $50 billion or more in total assets to determine whether they have sufficient capital to continue operations through periods of economic stress and market turbulence, and whether their capital planning frameworks are adequate to their risk profiles. The expectation embodied in our stress testing program that large banking organizations should maintain sufficient capital buffers to withstand a period of significant stress promotes the resilience of those firms and of the financial system more generally. While our stress testing program has been successful since it was first introduced in 2009, the crisis reinforced the need for regulators and supervisors to continually revisit the effectiveness of their tools and adjust as needed over time. As my written testimony indicates in more detail, and as my colleague Governor Tarullo discussed in a speech earlier this week, we are now considering making several changes to our stress testing methodology and process. A leading idea that has emerged from a substantive review of our Comprehensive Capital Analysis Review, or CCAR program, is to integrate CCAR with our regulatory capital framework, thus effectively including GSIB surcharges in the stress test. We are also considering making certain changes to the stress test assumptions used in CCAR. In addition, we're considering exempting from the qualitative portions of CCAR any bank holding company that has less than $250 billion in total assets and that does not have significant international or non-bank activity, as well as reducing the amount of data that these firms are required to submit for stress testing purposes. On this and other changes to CCAR that we're considering, we will, of course, seek public input before moving to adopt them. I know that community banks play a vital role in many of your districts. Among the lessons of my years of experience at the Federal Reserve have reinforced is that when it comes to bank regulation and supervision, one size does not fit all. To effectively promote safety and soundness and to ensure that institutions comply with applicable consumer protection laws without creating undue regulatory burden, rules and supervisory approaches should be tailored to different types of institutions, such as community banks. The Federal Reserve has already done a considerable amount to reduce regulatory burden on community banking organizations, but we're looking for additional opportunities, including potential simplifications of the regulatory capital framework for community banks. In conclusion, our post-crisis approach to regulation and supervision is both forward-looking and tailored to the level of risk that firms pose to financial stability in the broader economy. Standards for the largest, most complex banking organizations are now significantly more stringent than the standards for small and medium-sized banks, which is appropriate given the impact that the failure or distress of those firms could have on the economy. As I've discussed, we anticipate taking additional actions in the near term to further tailor our regulatory and supervisory framework. Yet even as we finalize the major elements of post-crisis reform, our work is not complete. We must carefully monitor the impact of the regulatory changes we have made and remain vigilant regarding the potential emergence of new risks to financial stability. We must stand ready to adjust our regulatory approach where changes are warranted. The work we do to ensure the financial system remains strong and stable is designed to protect and support the real economy that sustains the businesses and jobs on which American households rely.
Thank you, Chair. The Chair now recognizes himself for 5 minutes for questions. First, Chair Yellen, please know that I was encouraged by many aspects of your testimony. I believe there is hopeful, growing bipartisan consensus that we need more tailoring of regulations. And particularly on page 13 of your testimony, your recommendation that Congress consider carving out community banks from the Volcker Rule and incentive compensation limits in Section 956. I was also encouraged by your announcement today and what we heard from Governor Tarullo a couple of days ago concerning CCAR's qualitative review exemption. I think that is wise and a very small step in the right direction. Chair Yellen, before we get to the application of heightened prudential standards, I want to take a step back to how we do the SIFI selection process in the first place. As a member of FSOC, as you probably know, Dodd-Frank demands that there are 11 different factors that be considered in the SIFI selection process, such items as leverage, off-balance sheet exposures. In the SIFI designation process, do you weigh each of these 11 factors equally?
Are you talking about the non-financial firms?
Yes,
that the
Chair.
FSOC has designated?
Yes.
In the case of those firms, as required, the FSOC prepares an analysis taking
I know, but
those-
my question is, of the 11 statutory factors you must consider, do you consider each one equally? Or, for example, is leverage more important to systemic risks than factor 4, importance as source of credit and liquidity?
So when it comes down to looking at an actual firm, the question that FSOC has to consider, taking those factors into account, is special to that firm. And
So it's individual to the firm.
it's individual. The question is that
I guess where I'm going with this-
what would be the systemic impact on the U.S. financial system of the distress of that particular firm?
Well, with 11 different factors that are considered, combined, that leads to 2,048 different ways in which these 11 criteria can be combined. The statute says you shall consider these, but can I safely assume that you and other members cannot process 2,048 different combinations of these 11 criteria?
So what the analysis presented to FSOC does is look at the specifics of the balance sheet and exposures of an individual firm under consideration and analyzes how those factors would come into play and impact financial stability.
I guess my point, Chair Yellen, is it's hard not to conclude that ultimately this becomes a very discretionary process among members of FSOC. Let's now move to the living wills and CCAR process. So 11 banking organizations submitted rather voluminous living wills in 2014, and the GAO found that the Fed and the FDIC had not reviewed those submissions. I understand many of these submissions are thousands of pages long with respect to living wills. I've had at least one testimony that the CCAR reports are tens of thousands of pages long. I've heard one of 42,000 pages long. So I guess my first question is, does anybody at the Fed actually read these reports? And can I safely assume you don't?
You can safely assume that many people at the Fed read these reports. And
Does somebody really read a 42,000-page report cover to cover and know what to do with it?
Our staff and the FDIC staff do. And I think it's fair to say that all of the governors reviewed.
Okay, I find that very difficult to believe, but the GAO has said that these living wills can cost up to $105 million. The SBA estimates the average small business is capitalized with $30,000. So de facto, you're taking away the opportunity to capitalize 3,500 small businesses with a living will that may or may not be read, that may or may not be useful. Do you consider the cost of this process
we do,
as
but
you impose it upon the financial institutions?
We consider eliminating too big to fail to be a key objective of Dodd-Frank so that the American taxpayers will not be forced to bear the burden of a failure of a large firm. And I would tell you that the full Board of Governors met on the order of 12 times. We had around 12 board meetings to consider in great detail all the key aspects of the living wills of each of these firms.
I see my time has expired. The chair now recognizes the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. As you know, the reforms we have passed to make the financial system are constantly under attack, and many accuse us of one-size-fits-all regulations. As you know, the Dodd-Frank Act has provided the Federal Reserve with broad discretion to adjust the rules based on your evaluations of bank risk. I cannot count the number of Republican deregulatory bills that have passed the House floor, which were not serious enough to even be considered in the Republican-controlled Senate. However, I know that I, as well as other Democrats on this committee, have worked very constructively with you to identify areas of improvement and use your discretion to tailor regulations when necessary. Governor Tarullo's announcement regarding reforms to the stress testing process are a recent example of that cooperation. And I think you just said in your testimony that you were taking a look at banks with less than $250 billion in assets, and that you were considering some changes, provided they were not involved in a lot of trading and international trading in particular. Would you tell us what that is all about again?
Yes. There are two portions to the stress testing program for the institutions over $50 billion. One is a quantitative stress test to see what the impact in a severely adverse scenario would be on the firm's capital position. And we expect to continue subjecting all of the firms over $50 billion to that quantitative part of the stress test. But there is also a qualitative part relating to a firm's capital planning process. And that is something that currently all of the firms above $50 billion are subject to. And we are proposing eliminating that and reducing some of the reporting requirements associated with stress testing for the banks under $250 billion, as you said, that don't have a lot of international activity or non-banking business. And we think that our normal supervisory process, where we would look at the capital planning processes of these firms, is adequate, and that many of these firms are meeting our expectations, and this is a significant burden that we think we can relieve these firms of.
Well, I'd like to thank you for paying attention to the concerns that have been addressed by members of this committee, and I'd like to thank you for recognizing that not only do we have concerns, but these are concerns that can be addressed if we would but work with you, rather than coming up with all of this legislation that really interferes with your ability to exercise the authority that you have. I'm very appreciative of that. Let me go on to the next question. Chair Yellen, I've been closely following the progress on the living wills at the largest banks over the last 5 years, and I must say that I've not been encouraged by that progress. In April of this year, you and the FDIC finally took the important step of officially declaring 5 living wills as non-credible: J.P. Morgan Chase, Bank of America, Bank of New York Mellon, State Bank, and Wells Fargo. These banks are required to submit their wills to you in the next week. These banks have had 5 years to identify and address problems within their organizations. If any of their living wills are still insufficient in October, will you use your additional authority under the Dodd-Frank Act to quickly and severely reduce the risk these banks present to our economy?
We certainly do stand ready to use the authority that we have to impose higher capital and other standards on these firms if they have not corrected the deficiencies that we've identified. We've been very specific with the 5 firms in indicating what the deficiencies are. We've released to the public the letters that detail those deficiencies. We will carefully and quickly review the submissions that are due by October 1st to see if those deficiencies have been remedied. But I would say more broadly for all of the firms, the FDIC and the board identified a range of shortcomings, things that we did not think rose to the level of deficiencies, but nevertheless are things that we want to see corrected. And we will be reviewing the next round of submissions due in 2017 to see if they've been corrected or not. And it's conceivable that if there's been no progress, those things could later rise to the level of deficiencies.
Thank you very much. I yield back.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, chairman of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman. Chair Yellen, this month the Fed, along with the OCC and the FDIC, put out its required report on bank investment activities required under Section 620 of the Dodd-Frank. The Fed raises several concerns with physical commodity activity of financial holding companies under both the complementary authority and the Section 4040 authority. Last week, the Fed issued a notice of proposed rulemaking whereby it would impose significant capital requirements on covered physical commodity activities that would effectively prohibit many of these activities. In both the documents, the Fed relies on the term environmental catastrophic risk or catastrophic risk. How does the Fed define that risk, and how does the Fed measure it?
Well, the Fed has been motivated in this rulemaking by looking at the enormous environmental consequences of things like oil spills, the BP disaster, and other things, and the kinds of consequences that those can cause financially for firms and also reputationally. And we are concerned and have done a rulemaking on physical commodity activities, as you indicated, that attempt to address the risks that we think exist in that area, and have recommended to Congress repeal of the merchant banking authority for essentially the same set of reasons.
Yeah, but I guess the question is when you're analyzing risk, you go back and you look at past activities to determine do I hedge my risk against that? I guess the question is what past environmental catastrophes have posed a problem for financial holding companies? So can you point to something that say, gosh, if that happens again, there's a problem? I can't think of an event that happened that impacted those financial holding companies.
Well, under the Merchant Banking Authority.
But this is a different, there are two different authorities here, the merchant banking and then them being able to hold the commodities. I want to specifically talk about the commodities.
Well, we look at what's permissible and see that there could be environmental risks associated with it. It's not a question of just going back through history to see what has happened in the past. It's a forward-looking concern that the permissible activities could pose risks.
I'm a little afraid that we're just trying to think of things that could happen and then trying to make all of these financial institutions, somehow pay a punitive penalty in either capital or regulation for events that we may not have happened and may never happen again. I want to then turn to the GSIB surcharge and stress test. Some commentators have stated that the GSIB surcharge effectively works as a tax on capital market activities. Can you kind of name the components that make up the surcharge and what activities tend to increase the score?
There are a set of factors that are considered in determining the GSIB surcharge, including things like interconnectedness and reliance on short-term wholesale funding, factors that would increase the likely systemic repercussions of the failure of a firm. And as you said, the GSIB surcharges can be thought of as taxes imposed on these firms that serve two purposes. First, they, by insisting that firms hold more capital to address the risks that their failure could impose on society, on the broader economy, they ought to be less liable to fail, and holding more capital accomplishes that. And it may create an incentive for these firms to restructure their activities in a way to...
So when you look at that, for example, complexity is one of those. That, I think, talks about the size of the bank's asset that's involved in market making, and then interconnectedness components, primarily dealer-to-dealer trading assets used to for hedging and market making activity, and then cross-jurisdiction components of dealer-to-dealer trading similar to the interconnectedness factor. And when you start to look at all of those things that you're penalizing those entities for, it's making markets in the capital markets. And I think what many of us are concerned about is the message to the banks right now is just get out of the capital markets area, because the regulators are making it very punitive to be in those activities.
Time of the gentleman has expired. The chair now recognizes the gentle lady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Thank you, Mr. Chairman. I believe that Chair Yellen's performance so far has been nonpartisan, admirable, and has proven that she is more than capable of navigating these difficult waters and guiding the U.S. economy back to robust economic growth. So I am disturbed by anyone in a recent debate or anywhere who suggests that Chair Yellen is somehow acting politically. Nothing could be further from the truth, and I would like to thank you for the service to our country over your long career in government. And I would like to begin with a question on monetary policy before we get to regulation. You said last week at the FOMC meeting that one of the reasons the Fed didn't raise rates was because more people had come back into the labor force without the unemployment rate going down, which suggested to you that the economy, and I quote, had a little more room to run, end quote. But you also said that if things stay on the current course, you expect one increase in interest rates before the end of this year. So what does that mean? Does that mean that you expect the unemployment rate to start falling again soon? So in other words, does this mean that you think that the economy has a little more room to run, but not that much room to run? Exactly what did you mean?
So let me try to clarify. For this entire year, job creation has been running at a pace of about 180,000 jobs per month. And that is a pace, it's a little bit less than we saw in 2015, but nevertheless well above the pace of job creation that's sustainable over the longer run given trends in the labor force. Now, I've been pleasantly surprised to see that the unemployment rate actually, as I mentioned, hasn't fallen over that time because people have been drawn back into the labor force, and that's really means, and with inflation running below 2%, we're really not seeing meaningful upward pressure on inflation, and we haven't seen the unemployment rate fall. But monetary policy is accommodative. Eventually, continued job creation at that pace would cause the economy to overheat and would push the unemployment rate down to lower levels than now. So monetary policy is accommodative. We want to make sure that the expansion is one, and the good performance of the job market is sustainable over the medium term. If we allow the economy to overheat, we could be faced with having to raise interest rates more rapidly than we would want, which could conceivably jeopardize that good state of affairs that we have come close to achieving. So we expect to see the unemployment rate fall farther. We expect to see solid job growth continue, but we do need, if things continue on their current course, to gradually remove the accommodation that is there. Now, it's probably not that much. Our estimate of how much accommodation there is has come down over time as economists have reconsidered what is a neutral stance of policy. But nevertheless, there is accommodation. And while there's no fixed timetable for removing it, many of my colleagues indicated in their recent projections, the majority, that they would see it as appropriate to make a move, to take a step in that direction this year, if things continue on the current path and no significant new risks arise.
Thank you. Now I'd like to ask you about the stress tests also. Some people have argued recently that the Fed should put the economic scenarios it develops for the stress tests out for formal notice and comment for the public and for interested parties in order to let industry and others weigh in on the assumptions that you use. And of course, the fact that the Fed can tweak these scenarios every year to account for new market developments is one of the main reasons why I would say they're useful. So could you respond to that quickly? My time
Very
is up.
briefly, please.
Just very briefly, we want to make sure that those scenarios are based on timely information and address the most significant risks we see. We have put out for comment both the principles underlying our stress tests and information about how we construct the scenarios so firms have quite a good idea of what they can expect in terms of a scenario that they'll face, but all the details we don't put out for comment. It would
The time of the
involve
gentlelady
large delays.
Time of the gentlelady
Thank you
from
very
New
much.
York has expired. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, chairman of our Capital Markets Subcommittee.
I thank the chairman. Thanks, Chair Yellen. As you know, last week there was the big FOMC meeting, and surprise, to no surprise, the Fed decided to do what? To continue the extraordinary accommodative monetary policy. Now, I know you have taken the position that the Fed's position are all purely data-driven, and that's where some of the questions were before, and that has absolutely nothing to do with politics. But you know, less and less people really do believe that. Let me just give you 2 or 3 headlines out of last week regarding the FOMC meeting. From Politico, from right around here. Yellen helps Clinton dodge a bullet. From the LA Times. Is the Fed politically biased? Well, look at its interest rate decisions as the election nears. From Market Watch. A Fed rate hike and other important decisions, again, being put off until after the election. See, Chair Yellen, you have told our committee and the public on countless occasions that the Fed is not subject to undue political pressure. But as the saying goes, perception is reality. And whether you like it or not, the public increasingly believes that the Fed independence is nothing more than a myth. And the Fed has an unacceptable, cozy relationship both with the Obama administration and with higher-ups in the Democratic Party. Now, I brought this up a year ago, and let me run through some of those points that I raised then. You personally have weekly lunches with political and partisan heads over at the Department of Treasury. There is, in fact, a revolving door between the Treasury appointees and the Board of Governors. Your predecessor, Chairman Bernanke, had made a decision literally just weeks before the President had to go before the voters in 2012. And looking at your record, your speech on income inequality, something you never talked about before, but which became a major political theme for the administration, and you gave it just weeks before that last election. Now let me give you one most recent one. Maybe you can just comment on this in a couple of yes and no's. There's little doubt about last week's FOMC meeting that potential implications for the markets and therefore the election. But it was reported earlier this year that Fed Governor Lael Brainerd contributed the maximum amount to the Hillary Clinton campaign. And she did so while she was a sitting member of the Fed board. And there was numerous reports that have come out, media reports, stating that the governor is angling for a top job with the Clinton administration if Hillary wins. So some basic questions, knowing that's all out there on the table. Because of the appearance of conflict and impropriety there, has Governor Brainerd ever offered to recuse herself from voting at the FOMC? Has she? Yeah.
Governor Brainerd, like all of us, is subject to the restrictions of the Hatch Act.
Right. So has she offered to recuse herself because of
No.
her political involvement? The answer is no. Have you ever asked the governor? I'm sorry.
The Hatch Act does not prohibit political contributions.
I get that, and so, but we see the appearance of the conflict, and so it's a basic question. Has Governor Brainerd ever offered to recuse herself? And the answer is no. Have you ever asked Governor Brainerd to recuse herself because of her close involvement with the campaign and making contributions? Have you ever asked?
She's acting in a way that is permitted by the rules
So your
that
answer
we're
is-
subject to.
Right,
And
so
each one of us has to
I
decide
understand that. So the
for
answer is
ourselves.
the answer is she has never offered to recuse herself. The answer is you have never asked her to recuse herself. To your knowledge, has Governor Brainerd been in contact with the Clinton administration, or Clinton campaign, regarding a potential job in a potential future administration? Are you aware of that at all?
I have absolutely no awareness of that.
There have been published media reports talking about that, so you're not familiar with those media reports.
What's important to me is whether or not in our decision-making, our collective decision-making, I see politics being brought to bear in reasoning about our decisions. And I have never seen that on the part of any of my colleagues.
If you learn that she has had communications with Clinton as far as trying to get a job, would that change your opinion as to whether she should be asked to recuse herself?
I don't think that there is a conflict of interest there.
So a federal governor can be in direct negotiations with a political campaign looking for a future job, and that is not a conflict as far as you're concerned.
We do have.
No, is that a conflict or not? If they are having direct negotiations with either political party to ask for a job next year while they're a sitting governor, do you see that as a conflict?
Will the gentleman yield?
There's
I would like
no
to
time.
know. I would like to have an answer. Is that a conflict?
Will the
And if it is a
gentleman
conflict,
yield?
will you be asking the governors whether they are engaged in such activity?
Will the
The time
gentleman
that
yield?
the gentleman apparently is not yielding, the time of the gentleman has expired. Can the witness give a brief answer?
I would have to consult my counsel. I'm not aware that that's a conflict, but I would.
The time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Chair Yellen, Puerto Rico is currently facing a historic crisis. 46% of the population lives below the poverty line, 3 times that of the U.S. mainland. Employment in Puerto Rico stands at roughly 1 million, down nearly 300,000 from 2007. In the meantime, the U.S. economy has gained almost 10 million jobs in the same time frame. On top of these challenges, the island is struggling with Zika virus, and last week, a blackout swept the island. When the U.S. mainland faced severe challenges from 2007-2009, Congress passed and the President signed sweeping stimulus legislation, the American Recovery and Reinvestment Act. Do you believe that this legislation was helpful in fostering an economic recovery for the U.S.?
Well, I do think Puerto Rico faces very serious economic and fiscal problems, as you have described. They have been building for a long time, and the Commonwealth faces very significant challenges. I think the framework that Congress passed provides tools that maybe enable the Commonwealth to avert some worst-case scenarios, the ability to restructure debt should make it possible to put in place a fiscal adjustment that will be one that's less uncertain and hopefully entail smaller cuts to government spending. But
I
this is
understand all that, Chair Yellen. It will take time for the Fiscal Control Board to do its work, and the situation in Puerto Rico is really very difficult at this time. My question to you is, how can we spur investment in Puerto Rico? How can we foster economic growth and not wait for the Fiscal Control Board? Because the reality is people are leaving the island. The most productive workforce is leaving the island. They're facing serious problems with a healthcare system that is broken. And my question to you is, do you believe that a Puerto Rico-focused stimulus plan will have similar effect on the island's economy like we did here in 2008, 2009?
So this is really something, I'm not an expert on what the appropriate programs are for Puerto Rico to deal with its longstanding problems, and I think that's squarely a matter for Congress and the administration to consider.
Okay, thank you for that answer. We cannot forget that Puerto Rico is part of the United States, that we have a responsibility, a moral obligation. After all, we don't provide priority in some of the important issues that they're facing, such as Medicaid and Medicare. Chair Yellen, last Friday, the Federal Reserve Bank of Philadelphia launched a research and advocacy initiative to examine the interaction between economic inequality in the U.S. and its implication for macroeconomic prosperity and growth. What is the Fed hoping to learn from this initiative, and how is the Fed hoping its findings will further the economic inequality discussion?
So
I don't see it as a political plot. I see it as a contribution in terms of, promoting economic growth among those who have been left behind.
yes, I think the high level of poverty and inequality in the United States is a concern, should be a concern to all Americans, and an important challenge that our nation hopefully will address. And this initiative is really focused on trying to understand what some of the key factors are that are driving those outcomes, and looking at practice to see, based on real-world experiences with programs that are attempting to address poverty, what works and what lessons can be learned that might be of use to communities trying to deal with entrenched poverty.
Thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Luca Meyer, chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman, and Chair Yellen, welcome. We've spoken a lot about the sheer volume of rules coming out of the Federal Reserve. It's rule after rule, layer of regulation after layer of regulation, and that's really impacting financial institutions across this country, whether they serve a small community in Missouri or customers across the globe. Now we have the merchant banking and physical commodities involvement by the Fed, as my colleague, Mr. Nagelbauer, has indicated. And I hope that you work with this body with regards to those rules. Fed officials have made statements to the effect that the benefits of merchant banking outweigh the potential risks, yet we seem to be intent on trying to find a solution where there is no problem. That concerns me greatly, and I can assure you we intend to have a number of questions, written questions for you to respond to with regards to that issue. Today, though, I want to discuss the SIFI designation stuff that Mr. Trujillo announced this past week. I think it's important. We suddenly now recognize that the SIFI should be designated based on risk, not just on size. That's an important thing. Secretary Liu was here last week, made that same comment, basically, that we need to look at other factors other than size, and that seems to be your position as well now. With regards to that, can you tell me what administrative costs will be incurred by the Fed to remove the CCAR requirement?
I'm sorry,
Can you tell me what the costs by the Fed would be to remove the CCAR requirement of being a SIFI? The stress test?
Well, we believe that stress tests are a very important way.
I'm not talking about whether you do or do not do them. What is the cost that you're going, what's the savings that you're going to have? Or is there a cost to de-designate? Is there a cost to administratively remove the CCAR requirement? Is there a cost to do that?
Is there a cost in terms of dollars and cents that we
right.
spend
Yeah.
on it?
Does the Fed have to, is it cost you something to administratively remove the CCAR designate?
Does it cost
requirement?
us to implement it and to run the tests? And are you asking me,
I'm asking you to remove the requirement, does it cost you money?
does it cost us money to remove the requirement? It does
Yeah.
not.
Yeah, the CCAR requirement, does it cost you money to do that?
Does it cost us money? No.
Okay, that's what
But
I
I
want to know.
think it would be a cost in terms of safety and soundness. I think this
No, I'm not
is a-
talking about, I'm talking about the Fed. Does it cost you money to remove the CCAR requirement? You said no. That's what I need, and that's the answer to my
Well,
question.
any cost also that we incur in carrying out CCAR in the stress testing is passed on to those institutions who pay for the cost of their supervision.
Okay. Last February, the Office of Financial Research conducted analysis of the systemic importance of 33 U.S. bank holding companies based on basically the tenets of my bill, H.R. 1309. And given that all this work has been done, can you tell me what you think the cost would be for FSOC to de-designate and redesignate a financial institution?
For FSOC to what?
For FSOC to de-designate or redesignate these institutions if they are no longer SIFIs, according to the bill. I have a bill that says you have to look at these things, and if it shows that the institutions are not SIFIs, you have to de-designate them. And they redesignate them if they are, just to analyze them. Is there a cost to that?
Well, yes, I think it's clear that these institutions...
Can you give me a figure?
No, I cannot give you a figure.
Okay. Can you give me a ballpark? Is it $100, $1,000, $1 million, $10 million?
I can't give you
Okay.
an estimate.
Well, the problem is that the FSOC staff, which includes the Federal Reserve, informed the CBO that the de-designation and potential redesignation of banks costs, where there were over $50 billion in assets, would have an administrative cost of $60 million. Do you think that's reasonable?
I honestly don't know. I've not looked at it.
Do you have any idea how your staff arrived at that figure?
This is the FSOC staff.
Well, no, they did it in conjunction with the Federal Reserve staff, which is part of FSOC. Your staff came up with this figure. Do you have any idea?
I have not reviewed how they came up with that figure.
Okay. So if we write you a letter, you will be willing to give us a response on that as well?
Can try to do that.
Okay. Very quickly, you made a comment a minute ago with regards to what you've all done for community banks to help them with the regulatory problems, this inundation of rules and regulations. Can you give me several examples of that, please?
Examples of
Yeah.
what we have done.
Yeah.
We changed the small bank holding company policy statement to raise the threshold for capital regulation of
I think
small.
we did that in Congress, if I'm not mistaken, though.
You did, and we raised, but we put that into effect. We have
Well, I'm glad to know that you
extended-
implemented our law. Thank you very much.
The time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
Madam Chair, good move or non-move earlier this month at the FMOC. Now, some in politics on Monday will say that our economy is in such terrible shape that those who make economic policies are obviously incompetent. Then they'll come back on Wednesday and say it's urgent that we raise interest rates because our economy may overheat and economic growth could get out of hand. Only in this room can you juxtapose those two positions. We need to allow small business loans. I've been told by many bankers if there's a 2% or 3% risk that a business will go under, they can't make the loan. Jamie Dimon was sitting where you are now and said, well, he couldn't find qualified small business borrowers. under that standard. So he sent his money to London, where it was eaten by a whale. It would do a lot for the security of our financial system, and also help the economy of this country, if banks were able to make prime plus 3, prime plus 4 loans to businesses that had a little risk, and of course provide a reasonable reserve. Instead, I'm told if you don't qualify for prime plus 2, you leave the office. I join the chair in saying that it's a good idea to tailor your regulations, and I would say that the more SIFIs you designate, the less significantly you will regulate SIFIs. And it's the hugest institutions that are really systemic risks. But Madam Chair, I want to address the elephant in the room, or maybe I should say the stagecoach. I'll remind you that the FSOC has the authority to break up the biggest banks. And I've said that before in this room, and people said you must have animus to the true global SIFIs. No, study microbiology. The protozoa reaches a certain size, and then it divides. That's healthy. That's normal. If a protozoa can divide in a healthy manner, you'd think the smartest minds on Wall Street could as well. Too big to fail is too big to exist. Let's look at the elements of that. Too big to fail is too big not to bail. That's why we bailed him out in 2008. Too big to fail is too big to jail. That's why Eric Holder said he can't indict certain executives and institutions, because if he did, it would have too big an effect on the economy. Too big to fail is too big to compete with. That's why some studies say they get 80 basis points off their cost of capital. It might be less, because of the expectation of those providing the capital that if they get in trouble, we'll bail them out. But Wells Fargo has identified 2 additional reasons to break these institutions up. Because they created a system where they hired good Americans and turned 5,300 of them into felons. 2 million felonies. They failed to monitor the system. When they saw that there was that some individuals had created phony accounts, they fired 1,000 of them and didn't change the system and didn't fire the executives that created the system that created the first 1,000 felons until they had 5,300 felons. Now, from a Democratic side, I say too big to fail is too big to manage. From a Republican side, I've heard too big to fail is too big to regulate. But whether the fault is the regulators who can't regulate it or the managers who can't manage it, too big to fail is too big to exist. So my question for you is, will you seriously consider using your authority, as I think you're required to review and consider using your authority, will you at least seriously consider breaking up Wells Fargo?
Well, we will hold the largest organizations to exceptionally high standards of risk management, internal controls, consumer protection. We expect their boards.
But if you broke Wells Fargo up, then instead of trying to hold them up to those really high standards, people could choose, which financial institution to go with. They wouldn't pose a systemic risk by saying you're going to hold the giant institutions up to standards, something you have not been able to do 2 million times, 2 million phony accounts. So you're saying you're going to continue to do a great job of regulating the too big to fail because you're not going to break them up?
Well, we believe it is possible, even though it's extremely challenging for organizations to comply with the law.
2 million phony accounts not detected by the regulators. Break them up.
Time of the gentleman has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, Chairman of the Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman. And Madam Chair, appreciate you being here, but quite honestly, no offense, wish you weren't. We need to have the Vice Chair of Supervision to be here. This is something that the administration has refused to, a position that the administration has refused to appoint for 6 years now. Governor Trujillo has essentially fulfilled the function as position of from his position as chair of the Fed's Board's Committee on Supervision, but he is not in this position. And quite honestly, by refusing to fill this position, I believe that that the president has deprived Congress and the American people an opportunity to hold the Fed accountable through these semi-annual hearings. And this is a requirement of Dodd-Frank, the much vaunted Dodd-Frank that some of my friends believe is somehow holy script that can't be changed or altered in any way, but they conveniently refuse some of those other areas. Do you believe that there should be a nomination to fill this position?
We would certainly welcome a nomination.
Have you brought that up with Secretary Lew in your weekly lunches?
This is a matter for the administration to
But that's not my question.
decide.
Have you brought it up? I mean, you're having to be here in somebody else's stead. Have you brought it up with the administration or specifically Secretary Lew or anybody else?
I'm not going to discuss what I have discussed or haven't
okay,
with the
well-
secretary. As I say, it's an administration responsibility, and we would certainly welcome a nomination.
I guess we'll continue to hold you responsible for
I'm-
that obligation, which is
That's-
something that you shouldn't be held for, but
Well,
that's your decision.
I think
I'm going to go on, but do you believe that any and all rulemaking regarding regulatory or supervisory or supervision should be suspended until this vice chair is actually named?
No, because I think the Board of Governors is charged with supervision and putting in place regulations, and we're carrying
And then who do we
we're
hold
carrying
responsible
that
for
out.
that? Who do we hold responsible for that then?
Well, I'm responsible, and my colleagues are responsible,
Well,
and I'm.
as long as you're willing to fulfill that obligation,
we
that's an
certainly
additional
are.
burden on
Congress-
you, but
Congress assigned the Board of Governors that responsibility, and
Okay.
I am certainly sharing that responsibility with my
okay,
colleagues.
I need to, this is going fast, so I need to move on. I want to talk a little bit about monetary policy versus regulatory and supervision and supervisory roles. The fact is that in my Fed Oversight Reform and Modernization Act, the FORM Act, and by extension the Choice Act, we are trying to bring some separation to your function as monetary policymakers as well as your regulatory and supervisory roles. Former Senator and Banking Committee Chairman Chris Dodd, as well as Chairman Frank at the time, had advanced legislation or advanced the notion that those ought to be separate duties and that your regulatory and supervisory roles ought to be put on budget. I'm curious, were they wrong in that assessment?
Well, Congress decided to.
So you would
frankly,
welcome then, if Congress decided, you would welcome having that separation and putting your regulatory and supervisory roles under budget and with review, just like everybody else, every other regulator, versus the separation of your monetary policy duties.
Well, the banking agencies do not have their budgets mandated by Congress. They're covered by collections from the industry. I would very much worry that we would lack the flexibility under congressional appropriations to ramp up our supervision at times when it
But we've got an
appears to be
alphabet soup of all these
called
other
for.
regulators that are there as well. And so it seems to me you're wanting to have your cake and eat it too. You want to have this super duper regulatory role where it's Fed uber alles on this stuff, but you're not willing to subject yourselves to what the other regulators go through, and that just seems that. Rarely do I say that I agree with Barney Frank, but I believe that Chairman Frank at the time had this right, and that there is that separate role. My last issue, as we're quickly closing out here, some have believed that Dodd-Frank cannot be changed, at all, any way, shape, or form. You said on page 14, page 4, a number of times that there ought to be these adjustments. Have you spoken to these senators or other reps who disagree with you and say that we cannot touch Dodd-Frank?
A very brief answer,
Well,
please.
we have said that those would be desirable changes.
I hope
Time-
you're expressing that to the members.
Time of the
Crystal
gentleman
clearly
has
in
expired. The chair now recognizes the gentleman from New York, Mr. Meeks.
Thank you, Mr. Chairman. And it's a pleasure to welcome you back to this committee. And let me just say on the outset, I also, thank you for staying with who you are, being nonpartisan and independent, despite there being some, especially in the presidential politics of which we are currently engaged in, who's trying to say that your decisions are based upon a partisan way. In fact, I think that it's good when you are criticized from both the left and the right and from everyone. That probably means that you're doing the right job because you're not focused on either side. And we, in this committee, specifically reinforced the banking supervision's powers of the Federal Reserve in Dodd-Frank because there was clearly a need to heighten our banking examinations and regulatory framework. I think that that's clear from what took place back in '08. The good news is that we are seeing banks taking bolder steps to reduce risks, as you've indicated, and to exit out of certain risky activities. We do see some of that happening. Even if some would say that banks are bigger today than they were before the financial crises, that probably may be true from a simplistic perspective, but it is not a complete and accurate picture because not only have banks exited some of their riskier businesses, they've also boosted their capital and liquidity buffers, which surely increases the size of their balance sheets, but it makes them safer and sounder institutions. I mean, so this is a complicated stuff, which is true. And then yet we still have Wells Fargo, which, causes us to have great concerns as to what and where we need to go next. And we'll have questions with him. So there's been some progress, but then there's also unintended consequences. And I want to shift to that now just because it is well documented that one of those unintended consequences of banks de-risking has been that banks are getting out of certain communities and countries, and they are also denying services to millions of lower-income Americans, not because the risk is too high, but simply because the profit margins are not considered high enough. There have been serious consequences on vital correspondent banking relationships that are critical to international financial flows also. But another major problem happening in several communities here, including in a district like mine, is that banks are closing branches. In fact, economists from the Federal Reserve Bank of New York released a report last March entitled Banking Deserts, Branch Closings, and Soft Information, showing that U.S. banks have shut nearly 5,000 branches since the financial crisis. As a result, residents of low-income neighborhoods have become somewhat more likely to live in a banking desert. That is why I have called to revamp of the Community Reinvestment Act in a letter that was just mailed to a number of banking regulators and co-signed by 40 of my colleagues. Some are still signing on. So, Chair Yellen, it is obvious that CRA is not working as it was meant to work when it was passed 40 years ago. And I've had this discussion with OCC Comptroller Curry, and I strongly believe that part of the solution resides in enabling greater collaboration between large banks and CDFIs, including minority deposit institutions, so that these institutions can take over assets and branches before they close, and more importantly, so they can preserve banking services and relationships in low-income communities of color. So the Comptroller and I are in constant dialogue on this, and I would love to get some of your thoughts on this matter.
Well, I am concerned about banking services in low-income communities, and we are working with minority depository institutions to provide support to them in enhancing the very important and valuable role that they play in ensuring the provision of services to these communities.
So do you believe that we should, 40 years ago there was one thought of view, banking and CRA was put in so that we could make sure that you had institutions. Can you believe that there's ways that we can revitalize or revamp CRA to deal with the institutions and what's taking place today so that these communities are not neglected and then become part of banking deserts?
Well, we are having a look at CRA, and the agencies have put out additional guidance in recent years that's meant to address issues that have arisen, and we will continue to look at what further guidance might be appropriate.
Time of the gentleman has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, chairman of our Oversight and Investigation Subcommittee.
Madam Chair, welcome. Obviously, looking back to 2008, the crisis had a huge impact, not just on the financial service sector, but had a huge impact across our country and on many of the families that we represent. And I would argue that this massive Dodd-Frank bill was passed in a time of fear, where people were concerned about the future of our country and the future of their family. And a 2,300-page bill was passed before the dust had even settled, and we had a full analysis on what caused the crisis. And we were told by our friends across the aisle, who I would argue opened up their cabinets, their file cabinets, and dumped in every wish bag issue that they had for probably a decade. But they made a promise to the American people that when they passed that bill, they would be ending too big to fail. Because people were concerned not just about the economy, but the fact that the taxpayer, their money was going to bail out large financial institutions. Do you agree now, almost a decade on, that we have ended too big to fail?
Well, I think we've taken very significant steps toward...
No. Madam Chair, that's not my question. We were promised that we would end too big to fail. I wasn't here. That they would end too big to fail. So I think the American people have a right to know what you think. Have we ended too big to fail? Yes or no?
So, as I said, I think too big to fail is a less significant problem now than it was before.
So you're saying it's still a problem? We haven't eradicated the threat, have we? Too big to fail still exists. Yes?
I think we've made very important and meaningful strides toward ending it.
Madam Chair, these are simple questions.
I'm sorry, I don't think it's a black or white thing,
So you can
yes
say yes
or no.
I can tell you, Congressman Duffy, we have ended too big to fail. America is better off for Dodd-Frank and the fact that I'm the chair of the Fed. Or, frankly, no, we haven't. We haven't ended too big to fail. We've made progress, but we haven't ended it.
We have done a great deal to make it possible for a systemic institution to be resolved successfully.
So I'm going to take that.
The odds of accomplishing that are much better.
I think what you're, if I'm going to clear the smoke, you're saying we made progress, but we haven't ended too big to fail. And I think you're in a safe zone because Elizabeth Warren even admits we haven't ended too big to fail. The ranking member and my friends across the aisle will admit clearly in hearings here, we haven't ended too big to fail. So my question for you is a 2,300-page bill giving you and other prudential regulators significant authority that has had a huge impact on the financial sector and on our economy. If we haven't ended too big to fail, is it a failure of Dodd-Frank or is it a failure of the Fed?
I'm sorry, I'm not willing to describe it as a failure because, number one...
Well, we haven't ended too big to fail.
I'm sorry, no, we have made great progress in trying to achieve that, and it is not a black or white issue.
Does that answer work for my constituents? When I go home and said, this was a devastating crisis, it had a huge impact on your family, we're 10 years on, we had a 2,300-page bill, you can't get a loan from your credit union or your community bank, I'm not done, or from your community bank, and Chair Yellen came in and she said, we've made progress.
So we have a system that is much safer and sounder. It is much more resilient. It has much more capital, much more liquidity, and better, although certainly not perfect,
I
risk
full-heartedly
management.
disagree on many issues with Elizabeth Warren, but at least she's truthful on that one. Larry Summers recently, I'm sure you read his piece, said that to our surprise, capital information is at least superficially inconsistent with the view that banks are far safer today than they were before the crisis, and some support for the notion that risks have actually increased. Larry Summers, do you disagree with Mr. Summers as well?
I do. I disagree significantly with that conclusion because it is based on the notion that markets properly evaluated the risks in banking organizations before the crisis, and nothing could be further from the truth.
I'm going to give you one quote. In 1788, James Madison worried that laws may become so voluminous that they cannot be read or so incoherent that they cannot be understood. 2,300 pages in Dodd-Frank, 30,000 new regulatory restrictions, a 900-page Volcker rule, 600 pages of Basel III, and you can't tell me with all that rule and regulation that you haven't eradicated the threat of too big to fail.
Time of the gentleman has expired. The chair now recognizes the gentleman from Massachusetts, Mr. Capuano.
Thank you, Mr. Chair. Thank you, Madam Chair, for being here again. I just want to clarify a few things I think some of my colleagues made. I'm not aware of anybody who doesn't want to amend Dodd-Frank, including me. I want to amend it. I just don't want to gut it. Good amendments, thoughtful amendments, all for them. Gutting it, totally against. And that's pretty much the only bills we've been offered, is offered bills that would gut them.
Will the gentleman yield?
They're not going to get, not right now, no. But thank you. Too
Hold
big
my
to fail?
request.
Too big to fail? I agree. We should do more on it. That's why I offered the bill to bring back Glass-Steagall. All my colleagues are welcome to join that bill. That's why I offered H.R. 888 that the community bankers support. All my colleagues are welcome to join that bill. And that's why I joined my colleague on the other side, Mr. Garrett. Now, my God, if you're not paying attention, when Garrett and I can agree on H.R. 2625 that directly relates to the Fed's ability to bail out banks. All my colleagues are welcome to join that bill as well. I know Ms. Yellen wouldn't like that bill, and I appreciate that, but it doesn't kill you. It just kind of squeezes a little harder. There are bills that are out there to do more. All you got to do is read them and join us. If Garrett and I can do it, you sure as hell can find a way to do it. Don't get used to me and Garrett working together either, but that's a different issue. Ms. Yellen, let's assume, for the sake of discussion, that we had a large bank, a big SIFI, one you're keeping a very close eye on, that over the last 5 years has had 16 enforcement actions against them, including one from the Fed. Let's assume the bank had a Fed fine of $85 million. And in that agreement, the consent agreement that they signed with you, they said, or you said, internal controls are not adequate to detect and prevent instances when certain of its sales personnel, in order to meet sales performance standards and receive incentive compensation, altered or falsified income documents and inflated prospective borrowers' incomes to qualify those borrowers for loans that they would not otherwise have been qualified to receive. That was 2011. They're just obviously hypothetical, of course. And since that time, we've had 15 other violations across the board with pretty much every alphabet agency you can find: DOJ, CFPB, OCC, FinCEN, FHA, SEC, NCUA, and pretty much every state in the nation, totaling almost $11 billion in fines. Those actions included defrauding student loans, mortgage holders, credit unions, identity protection, kickbacks, insider trading, defrauding Freddie, defrauding Fannie, worker health issues, discriminating against African Americans and Hispanics, defrauding investors, foreclosure abuses, and on and on and on. And then just this year, earlier, when you rejected their living will, your letter cited concerns about quality control, senior management oversight, accuracy, the consistency of financial and other information reported, even though the firm's leadership steering committee had input to the plan. And now we have a same bank, just defrauded $2.5 million of its own customers. Its own customers. I'm sorry, $1.5 million. Don't you think it's time the Fed does something? How long does this stuff go on before you get outraged and take action?
Well, as you pointed out, we have done something. The action that you described in 2011.
You know that an $85 million fine to this bank is laughable. You know that. I know you know that. It's a lot of money to me and everybody I know, But to this bank, they made $23 billion last year. God bless them. They're a very successful bank. An $85 million bank is barely a footnote in their annual report, and you know that.
Well, as you pointed out, many regulators have been involved in.
Oh, I'm going to have my fun with them, too. It's just your turn today.
So we're, in the case of this institution, we're the supervisor of the holding company. We have already instituted a review of all of the largest banking organizations because we are very concerned with all of the compliance problems and violations of laws.
You know they're
that have
laughing at you,
occurred.
right? You know they're laughing at you.
The time
Well,
of
we
the
will-
gentleman from Massachusetts has expired. The chair now recognizes the gentleman from New Hampshire, Mr. Ginto.
Thank you, Mr. Chairman. Chair Yellen, to your right. Thank you. Thank you for being here today. I want to talk a little bit about community banks. You and I know the importance and the role that they play in our financial ecosystem. My state of New Hampshire is a small state, yet a resilient state, 1.3 million people, and we have very close relationships with our community banks. We've got 10 federally chartered banks, we have 16 state chartered banks, and we have 10 out-of-state chartered banks. So it's not a significant number, but they are very important and critical to consumers. But due to the severe regulations that community banks in my state are subject to, they are now limiting products and loans and services to their customers and my constituents. When community banks should be focused on providing access to credit for consumers, their focus and attention on meeting compliance with the burdensome regulatory requirements seems to take the priority of their time. I get reports from my community bankers on a regular basis that they can spend up to 25% of their time and resources on compliance, and this has been increasing as a result of the growth in the regulatory requirements that continue to be placed on them. So my first question would be, do you believe that there is a disproportionate impact of regulatory compliance on community financial institutions, institutions that are smaller, that service customers in New Hampshire?
So we want to do everything we can to reduce burdens on community banks and recognize that they are laboring under a significant set of regulatory burdens. We're going through the Agrippa process and looking at a number of concrete ways in which we can reduce that burden, and we've taken a number of steps on our own to reduce the frequency and intrusiveness of exams, to make it more risk-focused, to do more work not on the premises of the bank to try to reduce burden. You asked if the burdens had fallen disproportionately on community banks. The fact that they're smaller means that these burdens can be significant relative to their budgets, but the most restrictive requirements have been focused on the larger institutions, particularly the USG SIBs that are subject to a much more stringent set of...
But you do think there is a disproportionate impact on smaller banks, community banks?
There's quite a bit of research that's taking place. In fact, we have a conference that's taking place at the moment that's looking at those burdens, but
well, the reason I ask
they are
is
significant burdens for a very small bank.
The reason
there is a certain fixed cost involved in doing it.
The reason I'm asking is we've had 2 mergers in the last 6 months in the state of New Hampshire, and my fear is that that's going to continue. So I hope that you could identify very specifically and very quickly before the end of the year areas where we can reduce that regulatory burden. New Hampshire bankers are going to be coming to Washington tomorrow to meet on this very subject. They're very interested in it, and because our economy requires and relies on them. A different point I want to bring up, in your written testimony, You recommended that Congress consider carving out community banks from the Volcker Rule and the Dodd-Frank's Act's incentive-based compensation rules. Regarding your recommendation that community banks be carved out of the Volcker Rule, would you agree in concept that an approach worthy of consideration would be to exempt the Volcker Rule those banking institutions that do not engage in a material way in the activities that the Volcker Rule seeks to regulate, but keep those entities that engage in trading activities subject to the Volcker Rule?
So we've certainly said that we thought smaller institutions should be exempt, and the exact definition I would have to look at more carefully.
Okay, you also talked earlier about the 80,000 jobs per month that this economy is generating. Can you tell me, and you said the labor participation rate is changing, can you tell me what percentage of the labor participation rate is right now? Is it below 62%?
No, I don't believe so. Let me just have a look. It's currently 62.8%.
Okay, so I'm sorry,
Time.
my time has expired, but I don't think that has changed over the last several months.
Time of the gentleman has expired.
It hasn't changed over the last.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Hinojosa.
Thank you, Chairman Henserling and Ranking Member Waters, for convening this hearing. Welcome, Chair Yellen, and please accept my sincere gratitude for your leadership at the Fed. I commend you for acting in the absence of a Vice Chair of Supervision for regulation of bank holding companies and non-bank financial institutions. Confidence in the safety and stability of our financial system continues to strengthen even in the face of global market unpredictability and other emerging threats. We can attribute continued growth and stronger and more resilient economy to your leadership and the protections afforded by Dodd-Frank Act. My first question, Chair Yellen, is, in your opinion, do our financial regulators currently have the discretion they need to correctly tailor regulatory and supervisory standards, or should we in Congress take action?
Well, I think by and large we do have the scope we need to tailor these regulations. We've pointed out a few areas where we have limitations. The Volcker Rule is one, and the incentive compensation rules are another, where we can do some tailoring, but not as much as we would like. Congress did act to address the restrictions we faced in the area of insurance in designing an appropriate set of capital standards for insurance-centered savings and loan holding companies, and we appreciate that and have used it to propose a set of capital standards for those companies that we think is appropriate. So there are some areas where we've needed Congress's help, but by and large, we have a good deal of scope to tailor as we see appropriate.
You need to know that I continue to hear from banks of all sizes in my congressional district that they are burdened by regulations and costly stress tests. Several changes to the yearly stress test known as the Comprehensive Capital Analysis and Review were announced on Monday. Can you tell us what changes are being made to this review process and how that is expected to help community banks that are not internationally active nor participating in risky non-bank activities? And also, there are regulatory relief, there was in the Wall Street Journal an article that talked about trying to have some regional bank systems given some, if they are from $200 billion in assets or less, being given some relief.
Yes.
Talk about that for me.
So at the moment, banks over $50 billion have been part of our so-called CCAR, comprehensive capital and stress testing regimes. And the proposal that we put out on Monday that Governor Trujillo described would exempt from the qualitative parts of that process bank holding companies under $250 billion that do not have significant foreign activities or significant non-banking activities. So the less complex of those banking organizations, they would need to conduct the quantitative stress test, and we would conduct that, but the remainder of the capital evaluation, the qualitative part, they would no longer be subject to.
I'm also wanting to address the problems that in Wall Street and some of the investors, especially working families investing in their 401ks. How are China's economic troubles affecting the United States economy? And as the largest foreign holder of U.S. Treasuries with over $1 trillion in reserve, is the Federal Reserve concerned that recent selling of large quantities of treasuries by China could significantly and negatively affect the U.S. dollar?
Well, China's economy has been slowing from decades of very rapid growth. That's something to be expected, given all the progress they've made and the desirability of transforming their economy to a more consumer-based economy. By and large, that process is proceeding, and it's a good one from the standpoint of the United States, but it's very challenging. And earlier in the year and last year, there were disruptions in markets related to their currency, their approach to managing their exchange rate. They sold treasuries mainly to support their currency, which was under downward pressure. And in recent months, I think markets have been much calmer. I think they've
the time of the gentleman from
explaining their
Texas.
approach better.
The time of the gentleman
Thank
from
you.
Texas has expired. The chair now recognizes the gentleman from Oklahoma, Mr. Lucas.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for being here. I share, along with my colleagues, Mr. Nagelbauer and Mr. Luptemeyer, concern over a proposed rule that the Fed released on Friday, increasing the cost for financial companies to engage with their clients in physical commodity markets. As a member of this committee and a former chairman of the House Agriculture Committee, I have worked with a number of end users on issues associated with reform and regulation within the derivatives markets. And you and I have discussed on various occasions the nature of my district, 3rd District of Oklahoma, and the importance of stable commodity markets to my district. Over the past few years, I've heard from a number of commodity end users about their concerns on this issue. And I too am concerned about the impact this will have on our businesses and municipalities and their ability to participate in commodity markets. While we should, of course, continue to address risks to safety and soundness within our financial system, it appears that this rule simply seeks to discourage a company's participation in these activities through capital requirements rather than through an actual effort to target and mitigate risk within the system. In crafting this proposal, I guess my questions would be the following. In crafting this proposal, did the Fed examine historic loss data for banks engaged in physical commodity activities, as well as how losses in this business related to losses in other parts of the bank's business?
We did take a very careful look at the nature of banks' involvement in these areas and considered the risks that that activity entails. And it is important to recognize that financial holding companies would still, under these proposals, be permitted to engage in physical commodities trading with end users. That's not something that would change. What this proposal does is put in place additional risk-based capital requirements for activities that involve commodities for which federal or state law would impose liabilities if the commodity were released into the environment. So we're worried about environmental risk.
But Chairman, if you could provide us with the information on how you made those determinations, what the historic perspective was, how it's actually affected businesses, I think I and the rest of the committee would appreciate what the historic foundation was. It also appears that you're raising risk weighing to 300% for companies that engage in this business, which will of course make it much more expensive for all of these companies. Could you also provide the committee with the analysis that was used to arrive at this 300% as an appropriate amount? How did you get there?
We will get back to you on some details.
And I would simply note, Chair, again, I commented earlier, you and I have discussed this on many occasions. My district is agriculture and energy. We're wheat and cattle, we're pork, we're cotton, we're oil and gas, we're electricity, more and more every day generated by wind power. Having the tools to be able to hedge our products, having more participants in the markets give us, we believe, a much better price situation. If we restrict our tools to protect ourselves, if we restrict access to the markets by others, there's a great concern we will suffer, and of course, ultimately, the consumer who benefits from that supply will suffer too. One last thought or maybe a comment, and I'd like to reinforce one more time with you, Chair, of my interest and concerns regarding how Basel III treats derivative customers and their margin. Now, I understand that the Basel Committee negotiations continue, but recent reports are not encouraging for the end users in my district and the clearing infrastructure that has long supported their hedging needs. In this complicated world we live in, I guess what I'm saying is we need more tools, not fewer. We need more cost-effective tools, not more expensive tools. As in the case with Basel III, help protect us from those kind of consequences if it gets out of hand. And with that, Mr. Chairman, I guess I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman. And Madam Chair, thank you for being here. Really appreciate it. I want to go back to Mr. Capuano's questions around the Wells Fargo scandal. Now, I do understand that there's been a small fine paid by Wells Fargo, but in light of what they did here, 2 million fraudulent accounts, I know they fired 5,000 lower-level employees. There's been a little bit of clawback by the bank itself. But in terms of your role, you are the primary regulator for the bank, for Wells Fargo Holding Company, right?
We're the primary regulator for the holding company, but these abuses occurred in the bank.
I understand.
And the controller of the currency and the CFPB have authority, and they're the ones who brought these actions. We weren't involved.
And I give them great credit for that, as well as I think the Los Angeles authority was involved as well. Is there anything that you can do, looking what happened here? This was widespread. This is a disgrace, really, what happened. 2 million fraudulent accounts, and the low-level employees who were fired, didn't just think this up themselves. They obviously had incentives that were put in place. And any ideas from your standpoint as what might be done as a regulation or as legislation to prevent this from happening again?
Well, the controller of the currency and the CFPB have demanded in their actions that remedies be put in place. We now have initiated a broad-based review for all the largest banking organizations of their compliance regimes and governance.
Let me just ask you, this is a huge, huge thing here. Again, 2 million fraudulent accounts. Do you think can you think of any circumstances where a bank might be required to admit guilt? There was no admission of guilt here at all by the CEO or the bank itself. There was no admission of guilt. I mean, if it didn't happen here, how can we even imagine ever that a bank might be required to take responsibility for what they're doing? And I think by doing this, by continually letting the banks off the hook and nobody has to admit guilt, you actually build a perverse incentive for this stuff to happen. And I just, it blows my mind that they're getting away with this, and they're paying a little slap on the wrist fine that's not bothersome. And the CEO the other day said, well, it was only 5,000 employees. We got 100,000 employees, and 5,000 did this, and sort of, just blowing it off. It just,
Well, it is, I think it is very important that senior management be held accountable, and that when there are individuals, identifiable individuals who have been involved in wrongdoing, that
I know they're all lawyered up, but I think there's value in just getting after them. Just getting after. I don't care if you get a conviction or not. Just get after them and make their life hell. And we've got to create a disincentive in this system at some point for these CEOs to do the wrong thing. They completely. They completely ignored any of the safety and soundness and just basic responsibilities here. And I'd like to see somebody held accountable for that at some point. Let me ask you, it's a very clubby environment, the banks. And I would be amazed if this practice were just limited to Wells Fargo. I think it's probably the practice at a lot of banks. There's a lot of cross-pollination going on. People work for one bank, go to another bank. Are we looking at any of the other big banks doing this type of thing?
Well, as I see, yes, we are. The CFPB is in all the largest banks, and we are undertaking a look comprehensively, not only in the consumer area, but compliance generally, because there have been a very disturbing pattern of violations. They occurred in the mortgage area, in foreign exchange trading, in many different areas, sanctions violations, LIBOR, and we're taking a comprehensive look at the biggest banks.
All right, thank you. I have 17 seconds. I just want to say in closing, what a wonderful job the OCC and especially CFPB did on this. This is why they are there. And I very seldom hear great things about the CFPB. They did an amazing job here. This is a huge, huge win for the CFPB, and it redoubles my faith in that agency. Thank you. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Royce, Chairman of the House Foreign Affairs Committee.
Thank you, Mr. Chairman. Thank you, Chair Yellen. Good to see you today. I had a question, maybe it's a bit to follow up on Mr. Ginta's point about the unprecedented consolidation that we've seen in community financial institutions, where there are fewer and fewer of them, and these smaller institutions have fewer assets over which to spread their ever-growing compliance costs. So they often seek those economies then through mergers, and that's what leads to this conundrum now of a situation where we've got fewer banks today than we did during the Great Depression. And are you worried about the consequences of consolidation for communities and for our economies, and eventually for over-leverage as you end up with just a few big institutions having so much weight in that?
I do think it's essential that we have a vibrant set of community banks serving America's communities. They play a very special role in our financial system, and it's important that they remain healthy. Reducing regulatory burden is important. It is something that we will seek to foster using every available tool that we have. Community banks face a challenging environment, though, for reasons that go beyond regulation. The low level of interest rates and flat yield curve and slow pace of growth in the economy are also factors that are making it difficult for them to thrive. But they are tremendously important at the role they play for American households and businesses, and we will certainly do everything that we can to relieve burdens on them.
Yes, and some of that's driven by monetary policy, some of that's driven by fiscal policy. So that's another way in which they're adversely impacted by decisions made in Washington. So it seems to me at the heart of the consolidation, as you say, are these, well, it's really an avalanche of rules that have forced small institutions to hire extra staff. That's the situation, the economies of scale for them. And with that in mind, you said earlier that you're looking for concrete ways to reduce regulatory burdens on community banks, and you gave us some very specific recommendations on merchant banking and commodities activities in the Section 620 report that you released. Can you promise to send up specific legislative ideas as it relates to regulatory relief for community banks? If we could ask that of you. And then for now, I've got some questions on the report we received, because as part of the Section 620 report, did you study the effect that a repeal of merchant banking authorities and the loss of $27 billion in capital would have on small and mid-cap companies? And are you confident that if we act on those recommendations that are in that report, there will be alternative sources of capital for portfolio companies? That's one question I wanted to ask. And another is, based on your answer to my colleague earlier, is it correct to conclude that the recommendations for legislation in the report are based not on historical risks, they're based on, I guess, a projection of the possibility of potential future risks? And the reason I ask those questions is because as we look back at the financial crisis, there's no evidence that merchant banking and commodity activities were part of the crisis. What was at the heart of the crisis was a concentration of risk in bad home loans and securities tied to those loans. So as you limit activities of these community banks, are you concerned that you are limiting the diversification of risk and thus adding to the concentration? The harder we make it on these banks, the more concentrated the risk in the big investment banks or the larger institutions. And that could have a very negative impact on safety and soundness. And that was what I was going to ask you.
So our evaluation was with respect to alternative sources of equity financing, that private equity venture capital would be alternative sources, and that the merchant banking contribution here is not very large, that it would not have a significant negative effect. Of course, banks would still be able to provide a wide range of lending, advisory, and other financial services to customers. That would include startup firms, technology firms, and others. And they would have the ability to continue making investments in financial firms.
The time of the gentleman from California has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Ms. Yellen. It's wonderful having you back again. You know, each time you come, we talk about an issue that's dear to my heart, and that's the overwhelming unemployment rate facing young African-American men. Last time we talked, you said your monetary policy was a blunt instrument, and you urged Congress to introduce legislation to target this. Well, I took your direction, and I and my co-sponsors have introduced two pieces of legislation that I certainly hope you will say a kind word for. Because if you, knowing your dual duty as both inflation as well as unemployment, if you say a word of support here, you can help us pass these two pieces of legislation. Now, the first one is to deal with our crumbling infrastructure. That is coming. That is a big, big, big issue. What we want to do on this first bill is to address and develop a jobs and on-the-job training apprenticeship program targeting African-American young men ages 18 to 39. 18 to 39, they are the hardest hit for unemployment, nationally at 38%, and in some of our inner cities at over 50%. As you well know, it's in the news every day of the condition that many of our African American communities are facing. And so we want to set that up. It will come under the Secretary of Labor, who will coordinate these programs. It will work with the labor unions like the IBEW, the plumbers and pipe fitters, the iron workers, steel workers, all of those unions who will be helping to build our crumbling infrastructure. And we will bring these training programs and job programs, and let me just say, they will be in high technology areas, because you can't do all this without computer coding, computer systems, the technical aspects that are so desperately needed. Very important for us to get those in there and get that program started. The second one has to do with the education component. As you know, every 5 years, we have to reinvest in our what we call land grant universities. Those 1890s and 1860s that were set up after the Civil War. Schools like Tuskegee University in Alabama, Prairie View in Texas, Florida A&M, all of those. Well, we want to create a new area. Now they can only spend the money in education, research, and extension. We want scholarships to get these young kids in there. The big jobs are opening in agriculture business. It's the food we eat, the clothes we wear, now energy, high finance with derivatives and all of that. So we want to do that, give each of these schools $1 million, which they can spread over that 5-year period for scholarships. Now, these bills are bipartisan. We have some excellent co-sponsors. Folks like Kevin Kramer of North Dakota, Marcia Fudge of Ohio, Brad Ashford of Nebraska, Mia Love of Utah, Alma Adams of North Carolina, Gwen Graham of Florida, now Pete Sessions, who is our House Rules Committee chairman, all are on this bill. So a fine word from you would be very, very helpful. And I'm going to ask my assistant if he may give you, would you take those to them right now, Tanner, so you could have those. All I'm asking, and I'm not asking you to use the blunt instrument, I'm asking to use your golden voice. And if you speak and say a kind word, it will help us get these bills passed. And not only will the African American community thank you, but all of America, white people, everybody. We all know that these young black men with this highest unemployment rate of 18 to 39 are also the child-producing ages. This goes directly at helping us deal with that family breakdown structure. So we thank you for that. Now, Madam Secretary, I want to ask you one other thing. You know, you have an opportunity to do something very significant because I understand that your Fed regional bank president in my hometown of Atlanta, Dennis Lockhart, is retiring. We've never had an African American regional Fed president. I'm asking you, take this opportunity to make history. We have many excellently qualified African Americans who could do this. And finally, I want to applaud you and Frank Torillo for what you're doing with the car stress tests and committing to working with this continued flexibility. Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from New Mexico, Mr. Pierce.
Thank you, Mr. Chairman. Thank you, Chairman Young, for being here. I just want to kind of catch up now. The gentlelady from New York had mentioned the problems in Puerto Rico. If you were to just summarize those in a phrase, basically, what's the root of the problem there?
I think deep-seated structural problems pertaining to Puerto Rico's fundamental economic situation that have given rise and exacerbated fiscal problems. Those
Okay.
who've looked
All right, thanks. Now, when I'm looking back through through the 2008 crisis, I noticed that your balance sheet jumped from about $900 billion to 2.2 or something like that. What was the reason your balance sheet jumped during that period of time?
Primarily because we engaged in a program of purchasing long-term assets, both U.S. Treasury securities
Sure, you
and
got assets from the banks
agency.
who were having problems and kind of stabilized the banks, so you
Well,
built,
no, we didn't buy assets from the banks.
you bought
What-
assets from maybe Fannie or somebody. You bought MBS, right? You had mortgage-backed securities that you're purchasing that might have been toxic.
Well, I don't know that they were toxic. They were, they were put in receivership by
Yeah,
the U.S. government, and
The general perception is they were
agency guaranteed.
toxic.
We've
Okay,
continued.
all right, that's fine. Now, we were treated to Mr. Liu testifying to us a couple of days ago, and he identified in his testimony that he's required as the head of the FSOC committee to identify and respond to emerging threats to U.S. financial stability. Now, I pointed out to him that one of the doves on low interest rates, Mr. Rosengren, came out with his statement on the 21st in the Wall Street Journal saying, I think we need to rethink that there's a cost to full employment, basically. So, and he's talking about bubbling prices that might be caused by easy money. And so my question to Mr. Liu is, have the two of you ever talked that maybe one of the emerging threats to financial stability might be the easy money policy?
Well,
Y'all haven't had a discussion, or you have?
we do discuss threats to financial stability.
About
we monitor
your easy
them
money policy.
closely.
Have you specifically talked about that? If he's going to identify it, he ought to identify the easy money policy. That's not coming from me. That's coming from the guy that's most often on the side of easy money.
President Rosengren has singled out commercial real estate as an area that he's concerned with, and I would have...
He says that easy money policies could be letting markets get out of hand. That sounds a little bit broader than REITs. Easy money policies could be letting markets get out of hand.
Well,
now,
there is the possibility that in a world of very low interest rates that investors will search for yield and take on additional risks. And we're very much aware of that. And
so we got a difference of opinion among board members. But then you get something like Virtu says we're going to stay out of the bond market completely because it's hard to price the assets.
Because what?
Virtu, the largest e-trader, signaling that his company is going to stay away from many securities because the underlying assets are hard to trade, citing the volatility of the trades, the inability to sell or trade, hedge the positions.
What is he talking about, corporate bonds or what?
In my opinion, maybe the bond market overall. And so it just looks like that things aren't quite as stable. Maybe there are underlying problems. Maybe there are bubble prices. And remember that the housing market began as a bubble problem, stimulated by government policy. And so to have everybody sort of looking the other way and saying everything is good,
well,
and then I look at your asset, you typically increase. I just look the fact that your balance sheet is now up to $4 trillion so you've almost doubled in the last 4 or 5 years. So you're continuing to buy something, and generally, if the market.
We're maintaining.
And then I look at the debt. So Puerto Rico has got a roughly 76% debt to GDP ratio, and ours is 1-to-1. I'm sorry, but I think somebody ought to be talking about stability of the financial market in the United States because it looks desperately unstable. Thank you, Mr. Chairman. Appreciate your indulgence.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of our Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman. Thank you, also ranking member. Madam Chair, thank you for being here today. I believe history will be kind to you as well as to Chairman Bernanke. What you did was extraordinary in a time of great crisis. And I just don't believe those who look back, those who look through the vista of time, I don't believe that they will see these as unkind, unfair, unwanted, or imprudent things. I think that they will judge you well and you will be treated very well by history. Now, just a few things. I'm going to do my best to stay away from Wells Fargo. But I must tell you, it's difficult. Simply because, for one reason, if I may just mention this one, the $185 million in penalties is, according to some standards, about 3 days of profits. So this becomes a line item under the cost of doing business. So it's hard. I have some other things, but first let me do this. Let me just discuss with you the whole notion of too big to fail. Madam Chair, there's a bit of doublespeak taking place because a good many people, when they speak of too big to fail, they mean that there will never be another bank that will fail, as opposed to what I believe most people understand the case to be, not have a bank that's so big that when it fails, it creates misery throughout the economic order. That's what we're talking about. It can fail, we'll put it out of its misery without it creating economic misery. That's what too big to fail is all about. That's what Dodd-Frank does.
Yes.
We haven't finished Dodd-Frank yet. We're still implementing aspects of it. But too big to fail is addressed in Dodd-Frank, and it's addressed in a very profound way. The living wills. That helps us to understand how to put these big institutions out of their misery. Dodd-Frank allows us to separate them if we need to and eviscerate them if necessary. So too big to fail is all about winding down these big AIGs of the world without them taking the economic order with them. I'd like to make a point, if I may, before you respond, to the question of community banks. Madam Chair, the big banks have hijacked the term community bank. They've hijacked this term. You and I understand that most banks in this country are under $1 billion. Most of them, probably 89% thereabout. Under $1 billion. Well, the big banks have concluded that you can be a $50 billion bank, a $100 billion bank, and still be a community bank. Therein lies the problem, because when we make efforts to help the community bank, which are smaller banks, the big banks step in and they want all of the benefits that we would accord the smaller banks, the real community banks, a bit more doublespeak, the real community banks, they want those benefits. I applaud you for what you're looking at. I've read your statement, and you want to do something about this, an 18-month examination cycle. Look, there are people in Congress who'd like to help community banks, but we cannot do it at the risk of bringing in the big institutions who would benefit from it to the detriment of what we've been trying to do in Dodd-Frank. So I'm sharing these thoughts with you because I honestly believe that you have some great insight into these things. But my question has to do with something else. Here's my question. Given what we've done with the QE and all of the tools that you've utilized, how important is it for us to have some investments in infrastructure? Both presidential candidates have talked about it. Interest rates are exceedingly low at this time. How important is it for us to invest in infrastructure? Or maybe I should put it another way. Would infrastructure investments be helpful in promoting sound economic growth? I welcome your answer.
Well, I guess my perspective is that we've had very disappointing pace of growth in the U.S. economy, and productivity growth, the growth in output per worker has been exceptionally slow, 0.5% per year for the last 5 years, maybe twice that over the last decade, but low in historical terms. And that's critical to living standards, and investments of all sorts, I think, are essential to raise growth and promote improved living standards for Americans in the years to come.
Time of the gentleman has
Thank you, Madam
expired. The chair now recognizes the gentleman from South Carolina, Mr. Mulvaney.
Chair Yellen, I've got a couple of questions, and consistent with the hearing, almost all of them are regulatory, but Mr. Neugebauer just actually handed me one that's monetary policy, so I want to ask one very brief question about that, which is there's been some attention in the last few months about the recent decision by the Bank of Japan to start purchasing equities. And my question to you is fairly simple. Is the United States Federal Reserve looking at the possibility of adding the purchase of equities to its toolbox as it looks at monetary policy?
Well, the Federal Reserve is not permitted to purchase equities. We can only purchase U.S. Treasuries and agency securities. I did mention in a speech in Jackson Hole, though, where I discussed longer-term issues and difficulties we could have in providing adequate monetary policy accommodation, maybe somewhere in the future down the line, that this is the kind of thing that Congress might consider. But if you were to do so, it's not something that the Federal Reserve is asking for. And
it would take a change in the law to do that, is what you're saying.
It would take a change in the law, and there would certainly be
Let's move on to the
take
regulatory
into
questions.
account.
And I appreciate that. Thank you for straightening that out. Earlier, Mr. Neugebauer and Mr. Lucas both asked you about the proposed changes on the ways that you want to regulate commodities trading. And I guess my question on that is fairly simple. Why are you trying to do this?
But because we're worried about the risks that some forms of commodities activities pose to banking organizations.
I heard that, and I heard you give the examples about environmental hazards and so forth. But the truth is that's never happened yet, has it? That risk has never actually been incurred. No one trading in the commodities markets has ever been sued for an environmental. That Exxon Valdez didn't end up in a commodities trader getting sued. The BP oil spill didn't end up with a commodities trader getting sued. So there's never actually been that occurrence of that risk being incurred.
Well, it doesn't broadly prohibit commodities trading. It's focused on activities where there are significant environmental hazards.
And we can say for another day whether or not our 1,200% ratios prohibit. But the fact of the matter is you're trying to regulate a risk that has never actually in the real world been incurred by a commodities trader. Is that correct?
Well, we have had huge environmental accidents that have created enormous liability, and we do have a couple of banking organizations that Congress has grandfathered broad rights to engage in commodities storage and distribution, and those risks certainly exist.
You could make the argument that there are other risks that banks incur that are actually more tangible and perhaps more likely than an environmental disaster leading to a claim against them based upon commodities trading. It is, and no offense intended to any of my colleagues who are from the New York City area, it's risky for banks to be in New York, right? It's a target for terrorism. They've actually incurred that particular risk in the past. Could the Federal Reserve decide, in order to make banks safer, that they couldn't do business in New York City?
No, we have certainly not decided that.
Could you? In theory.
I don't know. I'm not sure.
I would suggest that you probably could. If you could do this, if you could say, look, we're going to require you to change your rules because of this risk that we perceive you might incur, even though you've never incurred this risk before, that same line of reasoning could be applied to something as esoteric as terrorism.
What we do require is that banks have robust business continuity plans and that they have backup authorities. So, for example, when we had Hurricane Sandy that greatly affected New York, that there are backup sites
systems.
and
Thank
robustness.
You for that. My last line of questioning has to do with something entirely different, which is cryptocurrencies and the blockchain technology. You spoke at an international conference back here in June. I think there were 90 central bankers, the IMF, and you talked specifically about blockchain. And I wonder if you want to take this opportunity to talk about the Fed's commitment to a light regulatory touch, and then also speak to whether or not you yourself at the Fed are looking at implementing blockchain technology in your operations.
Well, we're not looking ourselves at implementing it, but we are studying a whole set of fintech innovations and the ways in which blockchain is being considered for use by banks and non-banks. It could have very significant implications for the payment system and for the conduct of business. We want to foster innovation. I think innovation using these technologies could be extremely helpful and bring benefits to society. At this point, we're simply trying to understand the nature of these innovations. At the same time, consumer protection will also be something that's important, but we're not doing rule writing in this setting where we're trying to understand the ways in which these innovations are shaping the financial.
The time of the gentleman from South Carolina has expired. The chair now recognizes the gentleman from Delaware, Mr. Carney.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for coming in today to answer some of our questions. I have just a couple myself. Hopefully, I'll be able to get to them. The first, under the Volcker Rule, Dodd-Frank allowed an additional period of time for groups to divest of illiquid assets, and the Fed has acknowledged that they will need to make adjustments to the timeline, which currently ends July 2016. These investments, I think there was a question earlier about the commodities, are largely commodities, physical investments which are difficult to sell, illiquid by definition. I joined 11 other members, Democrats and Republicans, on the committee on a May letter to you asking you to refine your definition of illiquid asset and provide clarity on the timeline for institutions so they're not forced in a fire sale situation, which actually could help pension funds and others that are holders of these. So you've extended the time, I understand, to July of 2017, but a further guidance and decision hasn't been made. We did get a letter yesterday where you said the Federal Reserve Board in July indicated it would consider applications by firms for extension of the period to conform with these illiquid fund investments. Could you expand on that? Is that a case-by-case basis? You come out with a more general rule to provide some greater certainty for these institutions?
I think we are trying to establish some guidelines that would provide greater certainty. We're looking at that very carefully. I can't give you details, but we recognize there's a significant issue there, and we'll try to provide clarity.
Yeah, that would be great, just to provide some guidance so that they can, they're going to have to otherwise start selling these assets, really unwinding them really soon.
We understand that issue.
That's great. So I read through your testimony, and I was pleased to see some of the things that were done, and we've had some discussion about this with respect to modifying regulations, I guess CCAR in particular for smaller banking institutions. Do you have a sense as to what, the complaint that we all hear from the smaller banks is that these regulations require and they incur additional costs, mostly with staff that they have to bring on. Do you have any sense as to whether this will enable the banks to reduce their costs of regulatory
I think that this
compliance?
I think that this change to CCAR should be quite meaningful for the banking organizations that will be affected and make it a significantly less onerous process for them.
I guess at the end of the day, the question is whether or not they'll actually be able to reduce their staff that is dedicated to that function right now. I've talked to local banks in my area, in my state, and other places, and asked them when they said, look, this is additional cost. I said, well, help me understand. And they obviously went through individuals that were hired to address compliance.
So I can't give you an estimate
Sure.
of what the resource implications will be. They will still be required to conduct the quantitative portions of the stress test, but we are looking at ways for those smaller institutions to reduce data reporting burdens as well.
That's great, and we appreciate your efforts in that respect. The last question is really kind of pretty general, but you've been through this and have provided in your testimony your supervisory activities. We all talk about what happened in 2008, the last time. What worries you going forward? Do you think about going forward with respect to the current institutional banking framework as well? And there's been some discussion of that in terms of too big to fail. But what are the concerns that you have looking ahead?
So I do think we've made progress within the regulated banking sector. I think it's safer, and I think we have begun to deal with too big to fail and made progress there. I think we've addressed things in the shadow banking sector that are of concern as well. Money market fund reform is going forward. Areas of concern like the tri-party repo market, I think that's become safer. But I do worry about the migration of activities into less regulated parts or unregulated parts.
So outside of the
the
banking.
financial system, and new threats that may be different than the ones we've addressed in the past, like cyber threats, of course, are of tremendous concern.
Thank you, Madam Chair. Keep up the good work.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Ross.
Thank you, Mr. Chairman. Chair Yellen, thank you very much for being here. I want to talk to you specifically about SIFI designations. And I know that FSOC has the opportunity to designate SIFIs, and the Financial Stability Board does it with G-SIFIs. When the FSB does that, if they were to suggest that there was an institution that was globally significantly important, does that permeate or otherwise affect or influence the designation as a SIFI for FSOC?
No, FSOC has its own specific
guidelines
and does its own reviews.
And let's talk about those guidelines, because I know they were brought up earlier and they're statutorily put in there, but really, FSOC has had a tendency to deviate from those, haven't they?
To do what?
To deviate from those guidelines. In other words, let's look at the MetLife decision. The MetLife decision, I think, exposed something that we've been concerned about for quite some time, and that is the deviation from regulatory requirements that, for example, FSOC consider the actual losses of which, if a non-bank financial institution were to go under. And in the MetLife decision, I think the court found that wasn't done. In fact, I think the court in that particular decision said that one of the reasons they're overturning that designation is because there was no assessment of costs, or losses, I'm sorry, that's another part, no assessment of losses that would have been sustained had MetLife experienced the financial trouble. Is that correct? Is that your understanding?
Well, FSOC did a detailed study of what the potential consequences.
But they didn't calculate the losses, and I think that's one of the reasons. So they basically went at this very capriciously. And what concerns me about this, and I think that's probably pretty much what the court said too, what concerns me about this.
I was involved in the process, and I don't think it was
and I understand
capricious
that,
at all.
Chair Yellen, and which is why you would look to those who have the expertise in a particular field to rely upon making these decisions. And Roy Woodall, who is the only member of FSOC who has an insurance background, is the only one who voted to not designate MetLife, and yet that was ignored. I think he's getting a little bit of recognition from the court there, but why did you ignore his recommendation with his background? Insurance commissioner, understanding of the requirements, a different set of risk than bank and other financial institutions have to have? It just seems like it wasn't.
Well, there was a very detailed analysis done of the risks that MetLife's failure could pose to the U.S. financial system. Much of that analysis has been made available and is on the FSOC website. And
there's never been a run on an insurance company. I mean, let's face it, they have a 30-year risk assessment there as opposed to a bank that has a day-to-day, minute-to-minute. And I guess that, and I think this is what we're finding out from the MetLife decision, is that we have to address these non-bank financial institutions in a whole different way than we address the banking industry. For example, would you not agree that if we're trying to prevent too big to fail, I mean, that we keep these institutions solvent, that we have some kind of criteria where they can be assessed, corrected, and then be able to not be designated if they're following a process or procedure that prevents them from being assessed as a SIFI?
Well, only a few firms have been designated.
But they don't know they're designated until they're in what, stage 3?
They find out earlier than that they are.
But there's no off-ramp for them, I guess is what I'm suggesting.
Well, there is obviously an off-ramp. GE Capital is.
Well, they sold out. Now, GE Capital, that was an example. They basically said, we're going to just get rid of this because we don't even want to have that regulatory control to interrupt our book of business. That wasn't an off-ramp. That was a divestiture.
If they change their business model in a way that significantly alters the risks that they pose to the U.S. financial system, that is an off-ramp. That is, the FSOC reconsiders every year whether or not designations remain appropriate. It's an annual review process. And if a firm wants to, understanding why they were designated, make significant changes that reduce the risks they pose to the U.S. financial system, they can.
Thank you. And wouldn't it be in the best interest of the U.S. financial system to put them on notice as soon as possible so that correction can be made to keep them from having to be even considered as a SIFI?
Well, I think that the firms understand what it is about their activities that causes them to be designated.
Thank you, and I appreciate your testimony. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Ohio, Ms. Beatty.
Thank you, Mr. Chairman. Thank you, Ranking Member. And thank you, Chair Yellen, for being here today. I just have a few things. But first, let me say thank you for clearing up what we can do and can't do under the Hatch Act. When my colleague from New Jersey was asking about Federal Reserve Governor Brainard in that. But also, let me just say, I imagine in your historic position that you get a lot of people who want to have lunch with you or come and meet with you because of your scholarship and your brilliance. I can remember being over in the Rayburn room and could barely get in there when someone announced that you were there. High-powered people, more security in that room, and people just wanted to pick your brain and hear from you. So let me personally say to you, I'm glad that people in high places want to come and learn about what we do. Also, I probably, and you can nod or not, could probably safely assume that no one has pressured you from the White House or with President Obama to hold interest steady, to have some political influence. But it reminds me of 1972 during the Richard Nixon administration when Burns was in your position. And if you go back and you play those Nixon tapes, he succumbed to doing that because pressure was put on him by Republicans that he was meeting with to have an effect on that upcoming election. And I'm pretty sure you have not been asked to do that by our president or presidential candidate.
I have certainly never been pressured in any way by the administration. The administration, my experience has been, greatly respects the Fed's independence to make decisions in accord with our congressional mandate.
Thank you so much, Mr. Chairman. I just wanted to make sure we got that entered, that while maybe my colleague from New Jersey brought it up because he was thinking about what Republicans had done in the past. But let me move on and say I, too, joined that letter that hundreds of members of Congress sent to you. And let me just say thank you for that quick response. So often, people in your positions will come in and repeatedly we have to hear about the letters that were written and how typically Democrats don't respond. Not only did you respond, it wasn't a form letter. You actually acknowledged the concerns we had about minorities, specifically African Americans and women. And Mr. Chairman, she actually gave us not one, but 3 suggestions of what we could do to meet this challenge. So I wanted to personally thank you because I've been very hard on you and all the other federal organizations about working with minorities to improve the unemployment rate and to make sure that we have more women and minorities working in your organization. But let me just say this. I would like to discuss the diversity of the 12 reserve regional banks around the country, especially as it relates to the presidents of those organizations. Recently, there was an article that points out that we've had no African-American presidents. We've had 0 Latino presidents out of 134. So I want to make sure that we stay focused on that. I think we can do better than that. My staff and I were reminded of the Rooney Rule. And I don't know if you get that sports analogy or not, but let me just say to you and my colleagues, I'm going to have something that's called the Beatty Rule, where we would like to start with federal organizations like yours and simply say that as you look at these positions, you actually identify and at least interview one person who is a minority.
So, Congressman, I am very focused on diversity in the Federal Reserve, and it is a key priority. We've made some progress, but we need to do better. And I have created a work stream at the board to think about all of the different ways in which we can promote diversity in the work that we do. At the level of presidential appointments, I would very much like to see, I very much hope that we can see greater diversity in the FOMC. And in the search process, we require the banks to seek public input. We make sure, we at the board ensure there is a broad national search, that every attempt is made to assemble a diversified pool, and that qualified candidates are considered, and I really do hope that
the time of the
those
gentlelady
efforts
from
will
Ohio
pay
has
off.
expired. The chair now
Thank you so much. Thank
recognizes
you,
the
Mr.
gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman. Good afternoon, Chair Yellen. Chair Yellen, in his speech on Monday, Governor Torello notes improvements in the resolvability of GSIBs in recent years. He states that adjustments in all aspects of the program should be made as conditions and practices evolve. Well, the Fed has passed several rules pointing to resolvability. For example, margin requirements, a rule prohibiting derivatives, closeouts, and therefore a layman-like run, and single counterparty credit limits. In light of that, will you be recalibrating the GSIB surcharge before you consider including it in GSIB's post-stress minimums?
Well, we will put out a proposal. We're likely to approve a proposal that would affect the treatment of GSIB surcharges in our stress testing regime. We're not reconsidering at this time the calculation of those surcharges, but as Governor Trujillo explained, we have created an integrated system for incorporating those surcharges in our risk-based capital requirements and integrating the losses we identify in the stress tests as part of the risk-based capital regime.
To clarify, the GSIB surcharge, should it be recalibrated to ensure that it interacts with other bank regulations?
Well, I don't see a reason why it should be recalibrated at this time.
Okay. Following up on Chairman Hensarling's questioning regarding the statutory factors, are you aware of any firmly grounded research that measured how each of the 11 statutory factors that require your consideration contributes to systemic risk?
Those are a set of factors that generally do contribute
what
to
research?
systemic risk.
What research do you have that measured how each of the 11 contributed? Did you have research that related to that? What helped you determine that?
Well, I believe there's a wide body of research that looks at factors bearing on financial instability that identifies those factors as relevant.
Well, the legislating authority demands that each factor be considered. So yes or no, just please tell us, are you aware of any such research for each of these factors?
That quantifies its importance?
Yes. Can you state with clarity of the research, firmly grounded research that was attributed to establishing these factors?
Well, there are lots of research papers on this topic, but I would not say ones that quantify the impact of each factor.
Madam Chair, as you know, there's been some controversy over the settlement of the longstanding dispute with Iran regarding the transfer of the $1.7 billion in currency to Iran. I know the Fed helped facilitate this through the transfer pursuant to a comfort letter that was sent by Secretary Liu to Bill Dudley at the New York Fed. Don't care to really get into that, but I would like to address the issue that the administration told members of this committee yesterday that Iran needed those banknotes to help support the value of the Iranian rial. You're an expert in international monetary currency flows, so I'd like to ask you if there's any reason you can imagine why Iran having several pallets of euros and Swiss francs in the Central Bank of Tehran would help support the rial better than having that value on account in, say, New York Fed or the Central Bank of the Netherlands.
Sorry, I don't have an opinion about that. We acted as fiscal agent of the Treasury and have no involvement beyond following instructions that they give us with respect to payments.
So you don't have an opinion on that?
I don't have an opinion.
As a follow-up then, wouldn't it be actually more difficult and more expensive to try to support a country's currency with pallets of cash, especially if they were inside a country still largely outside the normal financial system?
I'm sorry, this is just something I haven't looked at.
Well, I ask this because some people believe that the real reason Iran wanted the cash was as though it could be used to enable acts of terrorism. And the committee has had a difficult time getting the administration to explain why they didn't just wire the settlement money as they had made on previous other payments.
I'm sorry, that's something you're going to have to address to Treasury.
Chair Yellen, we've dealt with the insurance factor some. Will the Fed first consult with the insurer's primary, well, my time has passed.
Time of the gentleman from North Carolina has expired. Due to the Chair Yellen's departure time, the Chair anticipates clearing Ms. Moore, Mr. Ellison, and Mr. Heck on the Democrat side, Ms. Wagner, Mr. Barr, and Mr. Rothfuss on the Republican side. The gentle lady from Wisconsin, Ms. Moore, ranking member of the Monetary Policy and Trade Subcommittee, is now recognized.
Thank you so much, Mr. Chairman, and thank you, Honorable Chair Yellen, for joining us here today. I have a lot of questions, so I'm going to move through them very quickly. You've had a lot of questions and concerns here today about why you've maintained interest rates so low when you're going to raise them and the inevitability of having to do that. But there's a growing course of community folk and workers who has challenged the Fed and their toolkit. They say that you've spent so much time worrying about inflation and being less concerned about labor market participation of vulnerable populations. People like to brag about the recovery of our economy, but African-American labor market participation is still fledgling. So I wanted you to give an opportunity to sort of explain to us what other tools you may have in your toolkit and how you're not ignoring that problem.
Well, the state of the economy and the labor market matters enormously to African Americans and disadvantaged groups. And it's very clear that as the labor market improves, African Americans see outsized gains, and that's where we are now, that they are seeing those gains, which is not to say they don't have much higher unemployment rates, and there remain obviously significant forms of disadvantage, but there clearly are gains taking place for African Americans as the labor market is strengthened.
How does that fit in with your
terrific.
decisions to raise interest rates?
So Congress has charged us with pursuing maximum employment and price stability, and we've been very focused on our employment mandate and remain so. We are pursuing a policy that will result in further strengthening of the labor market, and that's a very good thing. We also have to keep our eye on inflation, and inflation is running under our 2% objective. That gives us some headroom and some running room to remain focused on the employment side of our objective, but we have to keep both things in mind and are keeping both things in mind because we do have a 2% inflation objective.
Okay, Chairwoman Yellen, I want to ask you something that perhaps I haven't asked you before. I was here when we put Dodd-Frank together, when we put in place the Volcker Rule, and I spent a lot of time studying the efficacy of that. And yet we continue to hear calls to reinstate Glass-Steagall. Could you just share with us briefly about the importance of the Volcker Rule and the limitations or the importance of reinstalling Glass-Steagall, if you think that's the case?
Well, the Volcker Rule does prohibit proprietary trading, and the agencies that are charged with enforcing it are supervising to make sure that that market making can continue. We've discussed liquidity in markets and making sure that these firms can continue to make markets is important, but it does preclude proprietary trading, and we're
And Glass-Steagall, on the other hand, does not allow them to make markets. What would a Glass-Steagall look like in 2016?
I guess what a Glass-Steagall would require would be the separation of commercial banking and investment banking, and require restructuring of companies that now have substantial investment bank subsidiaries.
Is that a practical thing that we should look at?
Well, people have different views on this. We're trying to make sure that this can, these combinations can operate in a safe and sound manner.
Right.
I would say that that's not what was really responsible, at least in my opinion, for the financial crisis. In fact, some of the most serious problems took place in standalone investment banks,
right,
like Lehman and Bear Stearns, that weren't part of bank holding companies at all.
That's right.
And now they're subject to consolidated supervision, which is arguably a safer system.
Okay, and I have 10 seconds left. I'm wondering, you have a proposal to meet loss-absorbing capacity and long-term debt requirements
Yes.
Sorry about that.
Time of the gentlelady has expired. The chair now recognizes the gentlelady from Missouri, Ms. Wagner.
Thank you, Mr. Chairman, and welcome, Chair Yellen. As I know you're aware, the EU late last year issued a call for evidence to help provide data and feedback for a cumulative review of all of the post-financial crisis regulations that have been issued in the past 8 years. When asked whether the U.S. should implement a similar review, Governor Tarullo pushed back on the idea. Given that Governor Tarullo has not been appointed Vice Chairman for Supervision, what are your thoughts on the U.S. doing such a review, Chair Yellen?
Well, I think we are continuing to finalize these regulations and want to come to the end of implementing them, and targeted reviews of different aspects of the work that we've done become appropriate over time. As Governor Tarullo mentioned, I mentioned in my testimony, we have undertaken a comprehensive review of our stress testing program. We've consulted with the organizations that are affected by it, with outside academics. We've looked at its costs and burdens carefully, and we are going to be recommending, and already have to some extent, changes that we think are appropriate in light of those reviews. And over time, my guess is that other areas will deserve reconsideration. But
Ma'am, what's your timing on some of the recommendations you'll be making regarding some of the reviews that you've already taken?
Well, we already put out earlier this week a proposal that would exempt the institutions that are under $250 billion and don't engage in significant foreign or non-banking activities to be exempt from the qualitative part of our CCAR review. So that's already out, and other aspects of the proposal should go out shortly.
If I could continue, given that many foreign bank regulators, such as those in Europe and Japan and others on the Basel Committee, are pushing back against some of the capital rule proposals from the U.S., wouldn't it make sense for the U.S. to conduct such a kind of a comprehensive, I'll say, review as they are doing in the EU, particularly since the U.S. regularly gold plates their regulations beyond what Basel calls for?
Well, we have carefully looked at what's appropriate as we've undertaken these capital regulations. Some cost-benefit analysis has been done, and in the case of the GSIB surcharges, there was careful analysis done of the levels at which they should be set, and I don't think it's time now for a comprehensive rethink.
Well, and you talked about the stress test, and let me get to that. Governor Tarullo specifically said a U.S. call for evidence would be difficult to conduct and that it would require a very big model that would require a lot of assumptions. How is this any different, Chair Yellen, from the Fed's stress tests, which also incorporate a lot of kind of macro assumptions?
Well, in the case of the capital regulations and other aspects, what we're mainly talking about is reducing the probability and severity of a financial crisis. And one of the reasons that it becomes difficult to do the type of analysis that you're discussing is that financial crises, fortunately, are few and far between, and there is no clear, rigorous way to establish what is the probability and how does a particular regulation affect the probability of what is a tail risk.
In my remaining short time here, it's been 8 years. 8 years, Chair Yellen, and certainly the EU is calling vigorously, as are other countries, for a call for evidence and a review. Shouldn't the Fed at least attempt to understand the cumulative effects its rules are having on the economy? What are the other ways the Fed monitors the impact its regulations are having on growth?
Well, we are carefully monitoring how our regulations are working, and by and large, my conclusion is that we have a safer and sounder banking system.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Minnesota, Mr. Ellison.
Let me thank the chair and the ranking member. Chair Yellen, thank you for your great service. I definitely appreciate it. And, I'm of the opinion that, some of the criticism that you have to endure from certain quarters, is really, really is short-sighted, considering that the ability for, that the Congress has certain responsibilities to provide fiscal stimulus as well. And I think we have not done it. I think we've really kind of failed on it. And in fact, all we really ever talk about around here is how we can cut budgets as opposed to do things that I think really grow the economy. Anyway, that's just my opinion. I'll leave that on the side. It's quite clear that Wells Fargo misused employment incentives, setting up an unattainable cross-selling goal. 8 is great. I think it's a terrible corporate practice. Section 956 of Dodd-Frank directed the Federal Reserve, as well as other regulators, to finalize incentive-based compensation rules for financial institutions, such that those rules don't encourage, quote, material losses or, quote, inappropriate risks. Those rules were supposed to be completed 9 months after the passage of the act. Can you give me can you give us a status update on when we can expect to see those rules?
So the proposals, the reg went out for comment. Comments have been received, and I believe the staffs of the agencies are working through those now. I very much hope that we can finalize this rule. It has been a very long time, and I will do everything that I can for the Federal Reserve to be ready to act on this as soon as possible.
And recognizing the sensitivity of this whole situation, one of the things that's occurred to me is that the CEO, the chair of Wells Fargo, is, I think, pretty well compensated. The number I found was like $19 million. he's not losing his job, apparently not yet. And yet we did see about 5,300 people who were let go. Now, I make no comment on whether they should have been let go or whether they deserve to be, but when you set up a situation where you're incentivizing them moving the accounts the way that they were, and some of the demands that were put on them, you can kind of see how it could happen. I guess my question to you is, how can line level workers be held accountable to the degree that they clearly have been? And yet nobody in middle or upper management seems to be taking responsibility for it. I mean, they haven't lost their jobs. I mean, can you give us some insight as to how some of our banking management practices are being practiced so that only the people at the bottom end of the food chain end up bearing all the responsibility?
Senior management has a responsibility, and it's essential that they be held accountable. Compensation schemes that, for example, are based solely on volume are prohibited under the rule that the 6 agencies have proposed. But even prior to the adoption of that, the banking agencies have put out back in, I think, 2010 or 2011, supervisory guidance on compensation that had the same expectation. The board of directors should be reviewing compensation schemes and performance plans throughout the organization at all levels to make sure that they don't result in compliance failures, in ill treatment, that they have to be consistent with fair treatment of customers and consider risks. And this is an expectation, and it will be formalized in a rule, hopefully when the 6 agencies are able to finalize that. But senior executives are responsible, and they're responsible for setting up risk management schemes in their organization that would be detecting such problems, that they have a strong internal audit function that would be reviewing and detecting compliance problems, and that these problems would not only be acted on by senior management, but escalated to the board of directors that has an important responsibility here.
Thank you. So, and I really appreciate your answer because I agree with it. Now, my good friend from Wisconsin, Congressman Duffy, was asking you to respond about an opinion piece by Larry Summer. I got the sense that you might want to elaborate a little bit more on, what he asked you. Would you like to take the last 20 or so seconds just to sort of stretch out on your answer a little bit?
Yes. So thank you for that. So Summers finds that measures of riskiness of bank debt haven't diminished since the financial crisis. 2 reasons. He finds that one is that prior to the crisis, clearly market participants underestimated risk. And second, we're dealing with too big to fail, and investors can no longer expect that they will be shielded from risks if things go wrong in their firm.
The time of the gentleman from Minnesota.
Thank you, Chair
has
Yellen.
expired.
I appreciate it. I yield
The
back
chair
now.
now recognizes the gentleman from Kentucky, Mr. Barr.
Thank you, Mr. Chairman. Chair Yellen, I want to touch first on monetary policy and then shift over to the Federal Reserve's supervision and regulation of the financial system. Briefly on monetary policy, in your press conference last week, you stated that the recent pickup in economic growth and continued progress in the labor market have strengthened the case for an increase in the federal funds rate, and then you went on to say conditions in the labor market are strengthening, and we expect that to continue. And the headline on Bloomberg's website from covering this very hearing, is that Yellen sees solid job growth. But in response to my colleague, Mr. Ginta, I think I heard you say that the labor force participation rate has not moved. And of course, we all know that economic growth is weak. The Bureau of Economic Analysis reports that GDP output in the first quarter of this year was only 0.8%. In the second quarter of this year, only 1.1%. And productivity, which is a real important indicator of economic growth, is in retreat. It's been decreasing by almost 0.5% over the last 4 quarters. So the question is on monetary policy, how does your comments about economic growth and progress in the labor market square with these stubborn facts?
Well, economic growth has been very slow, and that's extremely disappointing. Productivity growth in particular has been really very, very low, and as you mentioned, in recent years, negative, which is a very depressing finding. And in that sense, the economy is not doing well. But we are creating a lot of jobs. The unemployment rate has declined to the neighborhood of what most of us would consider to be full employment. And there's a very significant downward pressure on labor force participation that's coming from the aging of the population.
Well, let's just say, okay, if I can just interject there, aging of the population may be one factor. The other factor is that unemployment is coming down not for a good reason, but for the wrong reason, namely that there is a frustrated workforce out there that's completely given up looking for work. Let me talk about maybe some of the causes of the drag on the economy. Obviously, you all have a role in conducting monetary policy, and one of the dual mandate functions is maximum employment. That's an objective of the Federal Reserve. But also supervision and regulating banking institutions to ensure safety and soundness is another important mission. But what I'm worried about, and maybe what might explain some of the drag in our economy, is that a regulatory overreach can be at cross purposes with your interest rate policies, and the left hand may not know what the right is doing. Let me give you an example of what I'm talking about. In the post-Dodd-Frank world, financial firms are supervised by multiple agencies, more than ever before. The Federal Reserve, the FDIC, the OCC, the NCUA, the SEC, the CFTC, the CFPB, the FSOC. These agencies are promulgating regulations, they're performing examinations. With respect to rulemakings, the approach of market regulators sometimes conflicts with the safety and soundness regulators, which in turn can conflict with the consumer protection regulator. And on supervision, often the substance of examinations overlap, but the timetables don't. And so data collection among financial regulators can be duplicative and uncoordinated. So this is not only a burden on financial firms, an undue burden on financial firms that may be a drag on our economy, but it also may lead to gaps in supervision. And so when you look at Wells Fargo and the scandal that we've seen there and the consumer fraud that went unpunished for 5 years, based on the timeline we've seen, and the primary consumer protection agency is coming in on the tail end of that, again, according to the timeline we've seen, do you acknowledge that maybe the lack of regulatory coordination and inefficiency may be a problem? And secondly, what do you think about proposals to consolidate or at least reduce the number of financial regulators, to reduce regulatory incompetence, to reduce regulatory duplication or conflict, or at least consolidate examinations and data collection efforts between and among regulators?
Well, we have a complicated regulatory system, there's no doubt about it. And we recognize that the issues you're discussing can create a great deal of burden. For our part, we work very closely with the controller, with the FDIC, and also with the CFPB.
Yeah, in my remaining time, and I don't have much time, but on the merchant banking activities rule, will you commit to the committee that before the rule is finalized, you'll provide us with an analysis of the type of costs that this could impose on companies?
It was a recommendation to Congress and not a rule.
Time of the gentleman has expired. The chair wishes to remind all members the chair intends to recognize the gentleman from Washington and the gentleman from Pennsylvania and then adjourn the hearing. The gentleman from Washington, Mr. Heck, is now recognized.
Thank you, Mr. Chairman. Chair Yellen, thank you so very much for being here. We're obviously moving toward a healthier economy. We're not quite there yet, but that notwithstanding, I think it's kind of useful to look even farther ahead to the next economic cycle. And that is why I read with interest that the committee projected last week that the Fed funds rate will top out at 2 3/4 to 3%. That can give you a lot of room to deal with the next recession, and as I am fond of saying, neither God nor anyone else has outlawed the business cycle. We will have another recession. So my question is, why don't you consider raising the inflation rate so that you have more bullets in your most powerful weapon to combat the next recession?
Well, this is something that researchers are looking at and are talking about, and for the reasons that you gave, I think it is an appropriate subject for research and for consideration if we remain in a low interest rate environment for a very long period of time. It's not something that the FOMC is actively considering, not at this time.
Are you open to it?
At the moment, I think it's not a priority for us to consider that right now, but I would not say never that it's not something. I think it's appropriate for researchers to consider the costs and benefits of it carefully. It's not something we're actively looking at, but I wouldn't say that it's something that we could never look at. But we are focused on trying to achieve our 2% objective. We want to emphasize that 2% is not a ceiling on the inflation rate. It's the target where we would like to be, that inflation can be above and below 2% at different times. We don't expect to always be there. I think we've realized—
Are you not concerned? I mean, the basis of my question is you don't have enough bullets in your most powerful weapon. Are you not concerned at all?
Well, I am concerned, and I gave a speech at Jackson Hole that addresses this issue. First of all, I think that we may be required to use the same kinds of tools we used during the crisis in the event of a future downturn, and I emphasized that those probably need to be permanent parts of our arsenal. And beyond that, yes, further things. It's important to do research on other things, and I emphasize that Congress should also consider what its role should
be.
I
actually
if we're
read
in
the
this
speech.
world.
Thank you. Last time you were here, I asked you, when does America get a raise?
What is what?
When does America get a raise? I want to go down this road again with you a little bit briefly. Obviously, the economy is moving, although not there, in a healthy direction. Car sales are up, home sales are up. Median household income was up fairly materially, but wage growth still stuck, I think, at about 2.5%. Even in the last week recovery, wage growth was 4%. Chair Yellen, when does America get a raise?
So wage growth has increased a little bit, and I think as the recovery progresses, we will see some more pickup in wages. But productivity growth is a very important determination of real wage growth or inflation-adjusted wage growth. If nominal wage growth were to pick up and inflation picked up in tandem, that wouldn't be a real wage increase. So what we want to see is wages going up without its involving inflation going up, and ultimately the size of those paycheck increases in the long run are driven by productivity growth, and productivity growth has been very low. And I think that's one of the things that is holding down the improvement in living standards. So we are seeing some signs of a pickup, but ultimately if productivity growth doesn't pick up, then faster nominal wage growth would just prove to be inflationary. So that's
quickly,
a fundamental driver.
Quickly, what would you define as full employment as measured by U6, currently stuck at about 9.7?
So I don't have a definition. It's higher than it was before the crisis, even though U3 is down to normal levels. And I think that does signify some remaining underutilization.
Time of the gentleman has expired. The chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Chairman. Chair Yellen, I just want to touch on one thing, following up on Mr. Mulvaney's question. I think you testified with respect to needing legal authority in the event that the Fed wanted to purchase corporate equities. Is that right?
Yes. I said we do not have
You
legal
do not
authority.
have, so you would need additional legal before you
right.
did something. The same hold true for corporate bonds?
Yes, we cannot purchase corporate bonds.
I wanted to take a few minutes to address some of the issues that I raised in my letter to you earlier this week. I'm concerned about the level of influence that the FSB has on the FSOC SIFI designation process. In a letter in February 2015 to the G20 finance ministers and central bank governors, Mark Carney, the FSB chair, made clear that member governors had an, quote, ongoing commitment to implement FSB's policies, and that, quote, full, consistent, and prompt implementation was essential. Though some may dismiss this as inconsequential prose, evidence suggests that FSOC operates in the spirit of Mr. Carney's words. 3 U.S.-based insurers that the FSB identified as GSIIs have also been designated by FSOC for Fed supervision. With that in mind, I wanted to ask you a few specific questions about the relationship between FSB and FSOC decision-making. What is the role of the U.S. members of the FSB in considering whether to designate U.S. insurance companies under the GSII process?
Well, a number of agencies take part in the FSB, the Federal Reserve, the Treasury, and the SEC are all members of the FSB and engage in their work.
Under the FSB charter, member countries commit to implement international financial standards. What steps has the U.S. taken to implement FSB's designation of U.S. insurance companies, AIG, Prudential, and MetLife, as systemically important?
Well, none, because the FSB designations have no impact in the United States, and the United States has to go through its own rulemaking process. The FSOC analysis is completely separate and focused on slightly different things than the FSB analysis, and they're entirely separate processes.
Did the Federal Reserve support the FSB's designation of Prudential and MetLife as GSSIs before FSOC had designated them?
The Federal Reserve only joined the IAIS that played a role here in 2013, and to the best of my knowledge, we didn't participate in their analysis that were the basis for some of the original designations.
But the Federal Reserve does participate with the FSB, yes?
We do participate in the FSB.
And in the process of the FSB designating these as GSSIs, what would the Federal Reserve's position have been?
I believe that I have to check this out, but I believe that the FSOC designations of these firms occurred before the the designations by the FSB, but I have to look at that more carefully.
Yeah, we want to follow up on that, because my understanding is that it happened, the FSB designated them, and then FSOC went and designated them. You know, because it seems that if you agree to designate a U.S. company as globally significant under the FSB regime, that would end up influencing that the company is going to be designated as systemically important within the United States. Wouldn't you agree with that?
Well, as I said, the FSOC process is separate, and I believe that the FSOC designations took place before the list of GSIIs was put out.
Could an FSB GSII designation be considered an, quote, other risk-related factor under Section 113 of the Dodd-Frank Act?
I'm sorry, I didn't.
Could an FSB GSII designation, if the FSB designates an insurance company as a GSSII, could that designation be considered an other risk-related factor under Section 113 of the Dodd-Frank Act?
Not to the best of my knowledge.
I yield back, Mr. Chairman.
Time of the gentleman has expired. I'd like to thank our witness for her testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for her response. I would ask our witness to please respond promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing stands adjourned.